Live from Studio 2 at Bloomberg headquarters in New York, this is a very special edition of the Countdown to the Close. I'm Scarlet Fu.
And I'm Katie Griefeld. We're in New York, but Romaine Bostick in Washington covering DC FinTech Week, where he will be joining us with some of the leading voices when it comes to markets, financial regulation, and a lot more, Romaine.
Yeah, a lot of folks, Katie, descending on Washington, D.C. this week for D.C. FinTech Week for the annual Sifma meeting. Adrienne Harris, the superintendent of the New York Department of Financial Services, she's going to be stopping by the big program in just a second. We're also going to hear from the president and CEO of Sifma, Ken Bentsen, who has a lot to say about some of the new regulatory proposals out there for the sector. And we're going to hear from Jim Reynolds. He's a legend in the municipal bond space. He's the founder, chairman, and chief executive officer over at Loop Capital, which he started all the way back in the 90s. It's just a small muni shop, and it's really grown, guys, into one of the biggest privately owned investment banks in the country.
Well, absolutely. A lot to look forward to there. But before we get there, let's take a look at these markets because it's another very interesting day. You have the S&P 500 up by 0.4% now. That might not sound like much, but that is the 7th straight day of gains for the S&P 500 if that holds. That would be the longest streak in 2 years, so it's going to be important to see how the next 2 hours go. Big tech having a better day. The NASDAQ 100 up by 1.1% as that bond rally really reignites, Scarlet. You have that 10-year Treasury yield down by almost 10 basis points on the day. We're barreling towards 4.5%, and all the while volatility continues to drain out of the equity market. Your VIX now below 15, trading with a 14 handle, Scarlet.
Yeah, lack of volatility, lack of transactions as well. The deal-making drought is forcing the biggest private equity firms to now switch gears. KKR and Carlyle are increasingly turning to businesses outside of their usual debt-funded buyouts as they report earnings declines from a year ago. We see KKR leaning in on private credit, capitalizing on increased demand for direct lending. Carlyle relying on its insurance business while also signaling it plans to be bigger in credit. Meantime, another story we're watching, crash and burn. Former high-flying startup WeWork files for bankruptcy, capping years of drama that saw the flexible workspace provider fail to IPO, crumble during the COVID lockdowns, attempt to go public through a SPAC, and then struggle in the continued remote work era. Following the filing, WeWork dumped about 40 leases in New York City as it tries to renegotiate payment terms with creditors. And of course, when it comes to the here and now for markets, there is a ton of Fed speak for investors to obsess over. Katie, I counted about 7 different central bank officials on the calendar today. Not everyone's talking about monetary policy, but those that are, I'm guessing they talked about a strong labor market, 2% inflation, and higher for longer.
Yeah, it's safe to say that that quiet period is very much over. And it seems like from all the different Fed speakers that we're hearing from, markets are hearing the same thing, that basically there's going to be cuts next year. At some point, that higher for longer message is going to turn into rate cuts. If you take a look at what's priced in right now, you have about 85 basis points priced in. So that's 2 full cuts and then some. Not quite at 100 basis points, but you can see that since basically the Fed meeting in the middle of October, that pricing has really priced in more cuts when it comes to 2024. And you take a look at how that's playing out across the different asset classes. We've been talking about the correlation between the bond market, between the stock market. You take a look at TLT and you take a look at SPY, of course, long duration treasuries, and you take a look at the S&P 500, and that correlation has really been growing. The net effect means that there's less places for investors to hide out when things go south. But of course, Romaine, I know that you're standing by with a very special markets guest, so I'll send it back to DC.
Yeah, let's get right to it. Jordan Jackson joining us right now here overlooking the Capitol. He's the chief global market strategist over at JPMorgan Asset Management. And there's been a lot of discussion here, Jordan, I guess, about the pace of what the Fed is doing, whether they're finally done, and I guess at this stage, whether investors should really care.
I think the Fed emphasized, or the data suggests that they can be done here, that they don't need to keep hiking rates. I think it's a little bit premature for the markets to get ahead of themselves and be pricing in such aggressive rate cuts over the course of 2024. Remember, the Fed started in the middle of the year, said they were going to cut rates 4 times in 2024. Then they came back and said we're only going to cut rate 2 times. And if the data continues to come in, I think pretty firm, which it has been, then I think this higher for longer narrative mantra will persist. And maybe this value valuation-driven rally that we're seeing in some of the big tech names. I think it's, again, valuation-driven, given the expectation for lower interest rates next year. I think it's a little bit premature.
So you think it is more about valuation, or the expectation of a shift in valuation? That's sort of behind the bid that we've seen going up in stocks right now.
I think so, because when you look at the earnings growth estimates for next year, they're still hovering around 10 to 12%, depending on which bottoms-up source of earnings data that you look at. And so we haven't necessarily seen big revisions come through yet for 2024. And so given the rally that we've seen in the market, I do think it is mostly valuation-driven. It still feels like a macro-driven market.
But how do you reconcile that with some of the concerns about the sales figures that we've gotten out of some of these companies? The idea that, yeah, a lot of them are healthy from a margin and profitability basis, but that sales growth that investors have gotten used to over the last few years just isn't there.
You're absolutely right. When we look at the data, 50% so far of reporting earners are missing on revenue, but 75% are beating on earnings. And what that suggests to me that as inflation is coming down, these companies have less pricing power in this market. But they've arguably done a pretty good job at cutting costs. PPI is down significantly, so input costs are down, while wages kind of feel a bit sticky here at right around 4 to 4.5%. I think companies have done a good job being more efficient with their labor, so cutting jobs where they can, and keeping those jobs on the books.
I am curious. So, I mean, Katie used the phrase hiding out. A lot of investors, that's effectively what they've been doing for the last year or so. Yes, they're buying stocks, but they're sort of finding those pockets of relative safety here. When you go into those strategy meetings with your colleagues and your peers here, is there a discussion about more of a full-on embrace of equities?
We're still a little bit more cautious. Investors have been able to hide out in cash, and it's honestly been probably one of the best performing assets, just given that relative safety and now the yields that you're able to generate at the very, very front end of the curve. But we're being very selective in our equity exposure. You know, like we do like tech. These are good businesses, profitable business, but we like it at a reasonable price, right? We think sectors like energy that has still maintained some of that pricing power, maintaining a little bit of defensive posture within the portfolio, maybe owning actually some defensive companies. And this is in an environment where there's a lot of geopolitical uncertainty overseas, and so you could see a bit of a tailwind there. Obviously, if rates continue to come down, you've seen REITs and utilities continue to perform well on the back of lower rates as well. I don't know if I'd lean into that trade a little bit. Again, I'm still a little bit more cautious of maybe another backup in yields, and that threatens those interest rate sector sensitive parts of the equity market. So overall, right, I think you need to be very selective in this market. We're not going full on beta just yet, but I think we're getting close. Well,
let's talk about, I guess, what's going on in the building behind us here. I mean, do investors need to start worrying about that? Last time I checked, we still don't have a budget deal, and I think we have less than 2 weeks in theory for them to get something done. When does that become a concern?
Markets don't like uncertainty, whether it's geopolitical uncertainty, domestic political uncertainty. All this adds another cloud over the market. And so I do think you're going to start to see more jitters around kind of that November 17th date if we don't have a deal. Obviously, I think markets are going to be concerned about politics over the course of 2024 as we head into an election year. You tend to see markets be choppy for an election and then rally once you get that certainty back in terms of what the administration is going to look like over the next 4 years.
I know a big part of your job is keeping tabs on obviously what's going on in the short term, but obviously you have a much longer term view as well that you have to have. Given what's happening in the short term, how much, if at all, does that skew your long-term outlook?
Interestingly, not all that much. For a while there, we were saying the 60-40 portfolio was dead. Well, in some ways, I think it's been revived. Now, maybe tactically, you lean a little bit more on the bond side of things. The yields remain very, very attractive. When you think about the risk-reward profile coming from owning a bit of duration now, I think it actually pays to start to leg back into duration a little bit. But going forward, right, I think equity markets are going to be those drivers of bigger capital appreciation. I could see over the next 7 to 10 years, a 60-40 portfolio delivering 6.5 to 7% annualized, and that's a pretty good number.
Yeah, I mean that's kind of the standard of what they told us in the old days. You were supposed to get. Jordan, great to have you here, and great to have you stopping by.
Thanks, Romaine.
All right, guys. Jordan Jackson, global market strategist over at JPMorgan Asset Management. Scarlet.
All right, a lot more to come. Because coming up, Fed speak galore. Take your pick. Our pick is Minneapolis Fed President Neel Kashkari, what he tells Bloomberg about inflation and the future of monetary policy.
Plus, WeWork filing for bankruptcy. We'll tell you what happens next for a company that was once valued at $47 billion.
And we've got an all-star lineup of guests joining Romaine in Washington today, starting with Adrienne Harris, Superintendent of the New York Department of Financial Services, Ken Bentsen, President and CEO of Sifma, and Jim Reynolds, Founder, Chairman, and CEO of Loop Capital. This is The Close on Bloomberg.
Minneapolis Fed President Neel Kashkari says that policymakers have yet to win the fight against inflation and that they will consider more tightening if needed. He spoke on Bloomberg Surveillance earlier this morning.
Everybody on the FOMC is committed that 2% is our inflation target. We have to get inflation back down to 2% over a reasonable period of time. Ultimately, the economy will tell us how much is needed to get there. And I just don't know.
Well, at what point do you think you would believe you have tightened enough or not tightened enough? What is it that you're looking for?
Well, I'll give you some good news is that core PCE on a 3-month basis is running about 2.5%. And it's lower than the 6-month data. It's lower than the 1-year data. So that suggests that the disinflation is real. If we continue to see inflation numbers of that range, 2.5% or lower on a go-forward basis, that would tell me, okay, we are now on a path back to 2% inflation. But 3 months data is still only 3 months data. And if we see that start to tick back up again, that would tell me our job is not yet done.
Do you think that Fed Chair Powell has outlined some sort of guiding philosophy on where the bar is to cut rates, on where the bar is to raise them further?
Well, I think he's articulated very clearly that we're committed to getting back to 2% inflation, right? There's been some chatter amongst economists that maybe we should raise the inflation target. I think he's done a great job saying that is not on the table. We're not going to do that. We're going to get inflation back to 2%, and we're going to let the data guide us. We've moved very aggressively. We've made a lot of progress on inflation. We're not done yet, meaning inflation is not back to our target, and if we need to do more, we will.
Do you think that the bar to cut is still just as high as it was?
There's no discussion amongst me and any of my colleagues about when we're going to start preparing to cut rates. The only thing that's been talked about at all is that at some point, when inflation is well on its way back down, if we didn't back off a little bit, then real rates would be getting tighter and tighter and tighter. And that's real, but that's math.
That, of course, was Minneapolis Fed President Neel Kashkari. And let's get back now to Washington, where Romaine is standing by.
All right, Katie, well, let's talk a little bit more about that math. Lindsey Piegza joining me right now. She's the chief economist over at Stifel. And Lindsey, I mean, let's start off, first of all, is the Fed actually done hiking rates? I mean, should we expect something more?
I don't think we can say that yet. Right now, the data is not clear enough to suggest that we are on a sustainable downward trajectory to 2%. As we heard from Kashkari, the Fed is committed to getting inflation back down to 2%, not near 2%, not touching 2% and then rising again. They want to be convinced that we are at a point where we can see price stability reinstated on a longer term basis, and we're just not there yet.
I know 2% is a line in the sand simply because they said it is, but why can't we adjust maybe to the potential that that number needs to be higher?
Well, this is the number that the Fed feels comfortable that we can continue to grow the economy without overheating and also keep the economy stable without falling into a deflationary environment. So that really is a delicate balancing act, but moving that needle higher, that may put us on an unsustainable longer-term trajectory for the economy, and the Fed's just not willing to move that needle at this point.
But if a lot of the issues with inflation were structural, and to be fair, a lot of the issues with deflation that we've had since have also been structural, how much control does the Fed have over that?
Well, the Fed has control over the demand side of the inflation equation. So the Fed can raise rates as high as they need to tap down consumption, tap down investment. That results in a slower pace of activity and more benign inflation. The problem is, however, the Fed doesn't have control over international policy, over corporate policy. They can't control energy supplies, food supplies, fertilizer supplies. The Fed can't broker peace in terms of international conflict. The Fed can't print more ships. So there are some issues that are outside of the Fed's purview that is going to complicate the picture for the Fed to get us back down to 2% and stay at 2%.
If they are able to get us down there, or at least close enough to it where they feel comfortable finally sort of waving the flag here, what does the math tell you about the potential for rate cuts going forward?
I think rate cuts, as we heard from Kashkari, they're not even thinking about rate cuts at this point. So I think the Fed is going to maintain this message of higher for longer, which means higher for longer. Rates are not going to be reduced anytime soon. The Fed was very quick to reduce their expectation for rate cuts. Going from June to September, we went from 100 basis points to 50. If inflation fails to perform as expected, I think looking out to the final December SEP, we could easily see the Fed entirely remove any sort of outlook for rate cuts in 2024.
Are some of those revisions to their outlook, though, do you think that's based more on the inflationary side of the equation, meaning their fight to get it down, or is it based more on their outlook for the economic conditions, sans inflation?
I think it's both. I think the economy is proving surprisingly resilient. The consumer has consistently proved this surprising level of resilience. We've seen the economy buck the trend, and with over 500 basis points in tightening, that's not what the Fed anticipated. So I think it's both the performance of the economy and this sticky nature of inflation.
I'm sure you're aware of a lot of the moves that we've seen in the rates market and treasuries, and some of that has been driven, of course, by some of the supply issues that's coming out of the Treasury, not to mention just their overall financing costs now averaging much higher than what it averaged out over the previous cycle here. How much does that become a factor for economic growth, and how does that feed into the Fed's decision making?
Well, I think it complicates the picture because a lot of the support that we've seen for the economy was from the fiscal side. So if we see fiscal woes now take front and center the focus, we could see that wane precipitously. Now, there still is a lot of fiscal support coming down the pipeline from legislation that was passed over the past 12 to 18 months. But after that, where do we see this go? Do we talk about fiscal restraint? Do we talk about getting our fiscal books in order? Any sort of further contraction could compound the impact of monetary policy and slow the economy even more, but it gets us back on the track to more benign inflation.
Do you think that bazooka of fiscal stimulus that we got, do you think that was at its core inflationary?
Absolutely. You cannot flood the market, the economy, with trillions upon trillions of dollars and not expect an inflationary implication. Absolutely.
All right, Lindsey, it was great to have you here.
Thanks for having me.
Lindsey Piegza there, Stifel chief economist. Back to you in New York, Scarlet.
All right, and Romaine, we'll continue the conversation with you shortly because we're going to discuss the future of AI in banking. We've got highlights from Michael Hsu, U.S. acting comptroller of the currency. That is next on The Close. The idea of the future of AI in the banking system, that took center stage at FinTech Week 2023 in Washington, D.C. Our anchor, Romaine Bostick, was there, and he hosted a panel with Michael Hsu, acting comptroller of the currency. Romaine began their conversation by asking him how AI can best be used and regulated.
In our experience, what we see, to the extent that banks are engaging or have been engaged, especially on machine learning, it's really been a crawl, walk, run approach. With good controls, really focused on use cases that make sense and that meet the safety and soundness and fairness standards that we have. So I think some of the chatter is a little bit ahead of where the reality is, and we expect banks to continue to take that approach because it seems like the right one. Because there's a lot of opportunity there, but there's some risks. With machine learning, there's bias, discrimination, consumer protection issues. Those are very live. The banks know that. Supervisors know that. And with Gen AI, it's just a similar kind of profile in terms of opportunities and risks. We want to make sure we're really thoughtful about that.
But how do you mitigate that? Is that your role? I mean, when I hear the word bias, I think, is that the role of OCC? Is that the role of other banking regulators?
Yeah, so our mission is, we got, the parts of our mission, make sure that the federal banking system is safe and sound, operates safely and soundly, treats customers fairly, ensures that customers have fair access to financial services, complies with laws and regs. So if you're going to be using AI, if a bank is going to be using AI in some way, to meet those fairness standards, to comply with ECOA, Fair Housing Act, it's got to be fair. And so you can't have discrimination and bias baked into that. There's a lot of promise with AI. One of the risks, though, it's a prediction machine, and that prediction machine is based on historical data. And so to the extent that historical data has biases in it, we want to make sure that we're not just moving into a world that just locks everybody in to the past. And so I think there's a trade-off there. And that's why we focus on things like explainability and governance and those kinds of things.
But how do you police that then? Is it sort of going back and looking at the input data, or is it more looking at the end result and whether you can find some sort of bias in that result?
So it depends on the use case. And so, there are plenty of use cases which are kind of lower stakes, where what's at issue is not going to have an impact on a particular consumer. There are other cases where underwriting, decision-making, clearly that's going to have a higher impact. And so we calibrate our supervision accordingly. And it's kind of all the above. So it depends on what the issue is. But if there's a risk of disparate impacts, disparate outcomes, then we'll pay attention to that accordingly.
Have you used any of these chatbots or any of these AI tools yourself?
So yes, we have. We've got an internal policy where we have made very clear to folks currently these are in public cloud, right? They're all kind of running, so no private information is utilized. But we have encouraged folks at the OCC, use it, right? Use it safely. There's guardrails around that. But we have to learn how to use these things because it's going to be part of the future. I've used it. It's been interesting.
And that was the acting U.S. Comptroller of the Currency, Michael Hsu, speaking with Romaine from FinTech Week 2023 in Washington. And Romaine, I feel like this is really uncharted territory. I can barely cope with customer service representatives outside the U.S., let alone giving AI a bigger role in banking transactions.
Yeah, but I mean, it's coming, and I think he was very cognizant of that. One thing, though, that he did say that I thought was interesting, Scarlet, was he really did acknowledge the lag, the idea that regulators are so far right now behind the industry. The industry, as you know, has just run forward with this, and regulators are still playing catch-up. Keep in mind, other than that executive order that Biden came out with, there's still no formal rulemaking out there right now, and we know that process, even once that rule is formally proposed, can take months and sometimes years to actually implement if there are lawsuits and challenges to it.
So beyond AI and what that might mean for the banking sector, I know it was a wide-ranging conversation. You were telling us, you talked a little bit about tokenization. Tell us more.
He did. Yeah, well, he's all for it. He wants to make that distinction between crypto and tokenization. Basically, his words were crypto is basically for the speculators. Tokenization actually has a real use case. Remember, Katie Griefeld, when everybody was telling us that crypto, you could buy a pizza, you could do all these transactions with it, and of course that never really materialized in any sort of meaningful way. But he actually sees a future for that, but he thinks it should be through tokenization. And get this, Katie Griefeld, hold into your seat, it should be centralized.
It should be centralized. So fiery words, and of course, people have been trying to draw this distinction between
he was kind of subdued when he said it, but he was just
Right.
very direct about it.
Very direct, very direct. Well, it sounds like a great conversation. It's great to recap it with you. Romaine, I know that you're going to be back with more insight on the impact of financial regulation in the next hour. You'll be speaking with Ken Bentsen. He is the president and CEO of Sifma. A lot of great conversations coming up and a continued focus on these markets. The S&P 500 on a 7th straight day of gains. Much more coming up. This is The Close on Bloomberg.
This is the countdown to the close. Let's get you a cross-asset check as we head towards the close of commodities markets. And a combination of a stronger dollar and mixed trade data out of China is really weighing on the commodity space, particularly energy and metals. Katie, you have the dollar stronger, and that's filtering through to a lot of red arrows for oil, for gold, for silver, for copper. The Chinese trade data also does not help with boosting any kind of confidence that stimulus will boost that part of the market.
Well, we go from commodities to one of the biggest stories of the day, and that, of course, is WeWork filing for bankruptcy, listing $19 billion of liabilities in that petition. The company entering bankruptcy after negotiating repayment plans with creditors, including SoftBank, allowing it to continue its operations. Here to unpack it is Bloomberg bankruptcy reporter Amelia Pollard. And Amelia, first of all, set the scene for us, because this is a company that has been struggling for a while now. So why file for bankruptcy now?
Yeah, so it's been a slow-moving train crash for honestly the last few years. And there was an out-of-court debt restructuring in March, if you remember, not even a year ago. And usually that's designed to stave off bankruptcy, hopefully for good. But ultimately, they just had way too many expensive leases that they had to get out of. And really the only way to do that is to do the in-court process of bankruptcy.
So they've already reached some kind of tentative restructuring deal with SoftBank, which of course provided a lot of the funding for WeWork. What can you tell us about that?
Yeah, so it seems like the lenders are going to be owning the company on the other side. And so that's obviously a proposal as of right now, and it has to be approved by the court. And sometimes we'll see things rehashed once the court process gets started. The first hearing is slated for tomorrow. But, you know, a lot of the debt is going to be converted to equity as it stands. And SoftBank obviously has been like one of the biggest champions and investors time and again for
and for
WeWork.
now losers.
Well, now loser, yeah, winner to loser. So that's currently the plan, but you know, it remains to be seen how that unfolds in the court process.
So where does WeWork go from here? Say that they emerge from the bankruptcy process. What does post-bankruptcy WeWork potentially look like?
I think fewer office spaces, that's first. You know, there's more than 700 globally right now. And a lot of those leases were signed in the 2018, 2019 era during the period of rapid expansion. And so it was really like top of the market prices for some of those leases. And so I think the goal is to continue operating, but with a smaller footprint. And it seems like there's still a lot of demand for the product. Sources I've spoken to have said that the idea has always been a good one, and it was really just too fast and too big of a footprint to really survive.
Has Adam Neumann said anything about this? The founder, the co-founder of
WeWork?
Yeah, where is he?
He did, of course, yesterday, even before the filing. He came out with a statement basically saying something along the lines of it being painful to watch on the sidelines. He stepped down, of course, in 2019, just days before the company backtracked on an attempt to go public. And so there's been new management in place. He's been, you know, doing his own ventures, which I have not really looked into. Maybe I will have to at this point. But it seems like he has been, you know, definitely making comments from the sidelines.
Yeah.
This was obviously his brainchild, and I'm sure it's been painful to see where it ended up today.
Well, great reporting. I know that you've been a busy woman. Our thanks to Amelia Pollard, of course, Bloomberg bankruptcy reporter. And this has just been one of the most fascinating corporate finance stories to watch. And like Amelia was saying, her sources saying it's a good idea.
Yeah.
I mean, just, you know, as a person speaking, it does seem like a good idea, especially when you think about the rise of flexible work. But burned too quickly.
Burned too quickly, yeah. Flew too close to the sun. Maybe shouldn't have opened up a couple of preschools along the way. But also the pandemic didn't help, right? That was the worst timing. It was like a perfect storm in terms of all the bad things happening. And then the slow return to office was also not great. And of course, now you have, it feels like it's the other shoe to drop in the commercial real estate saga.
Exactly, yeah. It's going to be interesting to see the ripple effects for the broader CRE market. But still ahead on the close, we're going to talk about Uber, of course, delivering mixed third quarter results. We're going to break down those numbers next. This is the close on Bloomberg. Time now for top calls. A look at some of the big movers on the back of analyst recommendations. And we start with HP, upgraded to buy from hold over at Edward Jones. The firm expects to see an influx in PC demand in 2024 as consumers opt to update their computers. The analyst also praises HP's ability to cut costs and improve free cash flow, not having a huge effect on shares right now, currently up about 0.2%. Next up, we have Olo. William Blair cutting its recommendation to market perform from outperform. Now, Olo, which develops digital ordering and delivery software services for restaurants, it reported solid third quarter results, but that was overshadowed by the news, of course, that Wingstop won't renew its contract with the company. William Blair says that this move, quote, reflects another large brand taking its tech stack in-house. You take a look at the shares and they are absolutely plummeting, down almost 26%. And finally, we have Peloton, cut to hold from buy over at Deutsche Bank, also slashing the price target from $13 all the way down to $4. Of course, while the analyst there continues to be bullish on Peloton, the analyst says that there's just too much uncertainty in the company's growth outlook. Peloton, of course, now has the lowest amount of buy equivalent ratings in its history as a listed stock. You take a look at shares right now, off by more than 4%. And those are some of our top calls. Now let's switch gears to Uber, reporting its third quarter results this morning, and its CEO spoke to Bloomberg TV about slowing revenue growth.
Well, the revenue growth slowdown is, again, purely as a result of these accounting reclassifications. If you look at the business and the bookings growth, which is really consumer demand, both on the ride side and on the delivery side, both of them accelerated. So our mobility business grew gross bookings 30% on a year-on-year basis. It was an acceleration over Q2.
And for more on Uber's results, we're joined now by James Lee. He is Mizuho America's senior analyst covering U.S. and Chinese internet stocks, and he has a buy rating on Uber. And when you parse through these numbers and hearing a little bit more from the CEO, should we be paying more attention more to the revenue growth or to the bookings growth here?
Yeah, good question, Katie. I think looking at the underlying of the business, or any of the gig economy company, whether you look at Uber or Dash, I think gross bookings is definitely one area one should look at very carefully. And if we look at gross booking as an underlying growth, the part of business actually accelerated for the quarter, about 6 points for the quarter. This is mainly due to picking up in terms of business travel and also increased adoptions of the new product, such as Reserve and Taxi as well. And if you look at the profitability of the business, they also did very well. The EBITDA guidance for 4Q actually is above the street by 5%. So overall, we thought the company delivery EBITDA actually beat expectation by 20% due to lower customer acquisition and also driver acquisition costs. So net execution was very clean, and we expect more catalysts coming up in the future quarters.
So clean execution, more catalysts coming up, and marrying that together with what, again, we heard from the CEO saying that Uber is well positioned for the journey ahead in good or bad macro environments. Talk to us a little bit about that, how Uber fares if we do head into a downturn of sorts in the U.S., maybe not even a recession. How does that affect Uber's business model and the ride-sharing industry overall?
Yeah, that's a fair point. And that's one of the things that management actually addressed on the call. And obviously, as a consumer platform, you are not totally immune as a company for Uber on any of the weakness on economic activities going forward. But relatively speaking, they're a little bit more resilient. If you think about them as a service, right, whether it comes to rides or food delivery, the price consideration for their product are actually lower than a lot of products out there that's considered high price consideration, for example, as travel. So relatively speaking, they tend to be more resilient than high price items, when you look at the consumer products in general.
Growth in the delivery segment was a little more sluggish than in the other parts of the business. And of course, Uber Eats competes directly with DoorDash. What is it that DoorDash does that Uber Eats could learn from or could emulate?
Okay, and that's a great point. And that's one of the things that Uber Eats they are working towards in 2024, which is to reduce the defect rate, the percentage of delivery that will return or exchange. And they see a lot of opportunity. What they talk about is that, they can save their defect rate going into 2024. If they're successfully doing so, that can capture additional EBITDA upside, going into 2024.
Gotcha. We were talking about WeWork earlier and how it was once a high-flying startup. Uber, no longer a startup either. But would you say it's a mature, profit-generating company already, or are there still some visible growing pains?
Yeah, good point. I think Uber at this point in time, if you look at their category-leading position in terms of ride-sharing, they are enjoying the economies of scale and also the network density that can continue to drive margin upside going forward. In terms of delivery, there are a lot more new opportunity. They recently enter into grocery delivery that can provide meaningful opportunity in terms of driving bookings and also advertising opportunity as well. Mm-hmm. So I see, part of their business kind reach the optimization of the EBITDA, with category leading position. Another part of the business that was got quite a bit of growth potential in delivery going forward.
Also, James, it looks like Uber at some point will be eligible for inclusion in the S&P 500. I wonder from where you sit what that means for its investor base and whether that will push Uber to return capital to shareholders through buybacks or through a dividend.
Yeah, very good point, right? They achieved GAAP EPS for the last 12 months, which means they are qualified to be inclusion in S&P 500, that being first. And also at the same time, I think they've been looking at their capital structure very closely, right? And in terms of looking at the debt structure, and there's a very good chance that their debt will be upgraded by rating agency to investment grade in the future quarter, and that will allow them to lower the cost of capital for funding, and also potentially as the company grow their free cash flow, they can look for ways to increase shareholder value, like get into buyback program, like you mentioned before.
Got it. James, really appreciate your joining us. James Lee is an analyst over at Mizuho talking to us about Uber, which of course reported results this morning. Now let's stick with the tech space and a rare move by Apple today. The company hitting pause on the development of next year's software updates for the iPhone, the iPad, Mac, and other devices so that it can figure out the glitches, clear those glitches in the code. And I find this to be kind of a relief because it's exhausting to constantly update the software for Apple devices.
That's a very optimistic tilt to take on this. And I mean, maybe that's working its way through the shares because Apple shares, maybe you would have expected them to be down on that news, but up 1.7%. It is interesting, of course, this is according to people familiar with the matter, that despite this pause, they plan that the software releases will likely stay on schedule. So some rare downtime, but maybe it won't affect anything too greatly.
Yeah, I always find it fascinating what the software can help you overcome versus the hardware, right? Like I didn't realize battery power is often linked to the software updates.
You know, I didn't know that either.
Well, maybe I have that wrong, but it seems like a lot of things get solved by the software updates.
Yeah, it's the software updates that I always just delay. Maybe I should actually do them and it would help things.
All right, we've got a lot more coming up on the close. John Goff, he is chairman of Crescent Real Estate and Contango Oil and Gas Company. He dives into the future of oil and gas and shares why he believes energy transition is misguided. We'll talk more about that. This is The Close on Bloomberg.
It's DC FinTech Week, and Bloomberg is on site. Live from Washington, Kayleigh Lyon speaks with Grayscale CEO Michael Sonnenschein and others. Tune in for a special one-hour episode of Bloomberg Crypto. Bloomberg, context changes everything.
From D.C. to Wall Street, it's time now for our Wall Street Week daily segment. John Goff, he is chairman of Crescent Real Estate and Contango Oil and Gas Company. He joined our David Weston earlier to discuss the impact of higher interest rates on the hotel industry and more. Take a listen.
It's certainly putting a dampening effect on any new competitive product. We have a number of properties underway, one which is about to be completed, which is the Crescent Hotel in Fort Worth, right in the heart of the cultural district. That was previously funded, so we're just completing. In fact, we're looking forward to opening it tomorrow. In addition, I have a Canyon Ranch development that's already funded with our strategic partnership with Beachy Properties, the NYSE company run by Ed Petoniak. And we announced that recently, and they are financing our Austin resort development, and it's underway right now. So fortunately, we have all of our projects funded, but to get funding for a new incremental project today would be very difficult.
Let me take the other side of that if I could. There's been some repricing in a lot of real estate because of those higher rates. That's the way the arithmetic works, as I understand it. I understand it may be difficult to get funding, but are there some bargains out there if you can find some funding because some prices have come down?
Absolutely. It's not like the early 90s when I started Crescent, and I would say we were, buying assets by the pound. We were able to buy just extraordinary properties that were newly built at fractions of what they were built for. Today, there's definitely discounts available, but it's not to the extreme that we saw in the 90s. But I think this is we're entering a period here where there are going to be great properties that will hit a debt wall, so to speak, and we'll be able to acquire some very attractive properties at compelling pricing. I don't think we're going to be stealing anything. I don't think anybody's going to be doing that, but I think there will be compelling pricing. But you have to find the financing. So we're looking to utilize very low leverage and a lot of really lean on our equity partners to finance our acquisitions here going forward.
John, give us your thoughts about another big business you're in, which is oil and gas. So where are we right now in the United States in oil and gas? Where's it going? We've seen a couple of big deals, particularly involving shale in the last 2 or 3 weeks.
Yeah, I think there's going to be continued consolidation in the energy sector. Look, I think oil and gas to me is incredibly attractive. And look, I'm all for doing the right things for the environment. But we have not seen peak demand. And those that say that we have are very much uninformed, in my opinion, and aren't looking at the real data. We haven't even seen peak demand in coal. We're woefully underinvested in replacing oil and gas reserves on a global basis. The energy transition is very much misguided, in my opinion. It's based on politics and emotion. It's not based on science and fact. And all we're doing is we're substituting one form of mineral extraction for another. Batteries in and of themselves don't create power. It's the minerals within the battery and the charging of the batteries that really creates the power, much of which is still being generated through oil and gas. And then if you just look at the backdrop of the population on the planet, we're going to add another 2 billion people by 2050, and that's going to be in these places like China, Southeast Asia, India, and Africa. And on a per capita basis, compared to Europe and the United States and Canada and Japan, they use far less per capita of oil and gas, but that's going to change as they aspire to a better way of life. So I don't think we're anywhere close to peak demand. I think we're woefully underinvested on a global basis. I think oil and gas is very attractive. My participation in that sector is primarily through a public company called Crescent Energy, which was formed out of a merger of a smaller company I had, public, called Contango, with all of KKR's energy business, which went under the name Independence. And we closed that roughly a year ago, and very excited about the prospects for this company.
So John, you said that current policy with respect to transition is based more on politics than on science. Let's put you in charge of the whole thing, government, private, everything else. If you're going to do it scientifically, what would you do? I assume you do think there should be some form of transition.
Oh, no doubt there should be a form of transition. But to simply set aside oil and gas as the crux of our economy, the crux of our energy capacity, is extremely naive, if not dangerous. So I think if you look at the production of energy and the efficiency of of oil and gas, and the efficiency and the manner in which that's being done, particularly by the more major companies today, it's being done in a far more environmentally sensitive way, as well as when you look at engines and how the technology that has developed engines that burn hydrocarbons, that can also be done in a much more effective way, whether it's hybrids or far more efficient engines. So to toss all this out and go to 100% electric and be reliant upon mining of minerals, which is highly destructive in and of itself to the environment, is, in my opinion, a fool's errand.
And that was John Goff. He's chairman of Crescent Real Estate and Contango Oil and Gas Company. Reminder that you can watch more from all of our conversations every Friday on Wall Street Week at 6 p.m. New York time. And of course, that is hosted by David Weston. Of course, Katie, they started off by talking about the impact of higher rates. That is the theme. It continues to be the theme for financial markets, although for today, equity investors seem to be shrugging it off.
Absolutely, and it helps, of course, that you look at the 10-year yield down 7 basis points, again, on historical levels, still high, but a little bit of a rally.
This is a close on Bloomberg. Almost 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Scarlet Fu.
And I'm Katie Griefeld.
And if we take a look at where markets are trading right now, it is green. So we continue. I think this is an extended rally that we've seen here.
Let me tell you all about
it.
It is 7 straight days of gains when it comes to the S&P 500. That's somehow the longest streak in 2 years. It really feels like it kind of came out of nowhere. The sentiment was so bad for so long. Probably helps with what you're seeing when it comes to the bond market.
Yeah, it just turned on a dime from where it was before, right? We are approaching 4,400 on the S&P 500. You'll notice that the dollar is stronger as well. Here you can see the pound slightly weaker as the BOE chief economist hinted that rate cuts there may be on the table in 2024. And across the commodities complex, whether it's oil, gold, silver, or copper, you see a lot of red arrows with oil sinking below $80. Knee-jerk reaction to the higher dollar, but also weak trade data from China weighing on prices.
And I mean, that's another asset class where, again, the sentiment was very one-sided. The direction of travel was one-sided for a while, and you've really seen a big reversal when it comes to the energy market.
Okay, you mentioned 7 days of gains. Let's just show a chart here because I prepped that one because I knew you were going to talk about it.
There we go.
The S&P 500 up 6.3% over this 7-day rally. Longest winning streak in 2 years since late 2021 when, coincidentally enough, before the Fed began its longest rate hike campaign.
And there we go. And of course, we should point out that the S&P 500 up 0.3% right now.
Yeah.
It still has, what, 59 minutes to hold that. So it'll be fun to see how trading finishes up on this day. But let's go through some of the individual movers because we have a lot of earnings stories to get to. I want to talk about Datadog. Of course, this is a cloud software company. It is absolutely flying right now, of course. You can see it's up, what, 29%. It was a beat and raise quarter, and it's really lifting the whole space right now. So pretty great, at least 1 quarter for Datadog, and you can see that surprise reflected there.
Yeah, and it's also helping to give other names in the space like Snowflake and MongoDB a big lift as well. When I looked at the most active stocks by value, all these cloud software companies are flying high.
Absolutely. Clouds flying high. I love it. Let's talk about Uber. Uber is an interesting one, of course. Delivered a mixed report. It really has something for everyone sort of feel from it. Of course, profit grew, but revenue slowed. It was record ridership, but again, a second straight quarterly profit there coming in as well. I don't know. You weigh it all together, the stock was up and then it was down, and now it's up again 3.5%. And I also want to talk about Olaplex. I thought this was interesting. This is a beauty company. It has like the hair oils, etc. It's flying again as well. 27%. That is the most on record. Apparently, sales came in better than expected, and that's really lifting shares today.
Are their products really expensive?
I don't really. I actually have a sample that I've been milking for like the last year and a half. So.
Yeah, I mean, I guess people are spending, but they're being very choosy about where they spend, and your hair is always worthwhile to spend on. All right, we're less than 1 hour away from the closing bell. We've got cross-platform coverage of today's top stories starting right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Scarlet Fu and Katie Griefeld here with you on the TV side, and we're joined now by our colleagues in radio, Matt Miller and Paul Sweeney. And because of that, welcome to all of our Bloomberg audiences across television, radio, YouTube, and originals. Matt Miller, good to see you again.
It's great to see both of you, too. I'm glad to be here in the chair with Paul today. Carol and Tim are somewhere,
On
Vegas
assignment,
or New Orleans
They
or
could
something.
be anywhere, honestly.
Yes, they could be anywhere.
In any case, they're missing out, right? It's their loss because we're looking at a 7th day in a row of gains, the longest string of wins in 2 years for this stock market, as Jay Powell is a little bit more dovish than people expected, and rates have come down. Oil as well,
Yes.
down under $78 a barrel.
Yeah, Matt and I were just talking about it. You know, have we seen peak rates a couple of weeks ago? Again, we've seen the rates pretty much across the board. You know, a couple of weeks ago, you look across the 2-year, the 10-year, the 30-year, it had a 5 handle on that. And was that the peak? And that's kind of what that's a question we're asking ourselves right
Paul
now.
Sweeney, peak rates. Are you on record?
Oh, absolutely. There's no recession either. I've been on record for that for about 3 or 4 months.
You know, you can say peak rates today, and tomorrow might be a completely different story.
Exactly.
Right? So you're good for now.
Well, I'm just trying to talk my book because I'd like to refinance my mortgage.
You and everyone else, right? All the people who are looking to buy a home. So there's a story that I was really intrigued by. Apparently, Steve Cohen, who, of course, is the hedge fund billionaire, but also the owner of the New York Mets baseball club, is planning to team up with Hard Rock International to propose building an $8 billion casino and entertainment complex right next to Citi Field. It's going to be on a 50-acre parking lot in Queens. Is this the death of Mohegan Sun?
It's so weird, right? They're going to issue, I think, 3 licenses for casinos in what is being called downstate New York. I would call it the New York City metropolitan area. And actually, they're going to call the park something like that. It's going to be Metropolitan Park, I think, around this complex. A 20-acre park. He's going to partner with a bunch of famous people who made, like, the High Line, right? But every time I look at Steve Cohen lately, I think of the guy who played Pyle in Full Metal Jacket, because did you guys see Dumb Money? Did you see Dumb Money?
Yes,
I want to. I haven't seen it
I
yet.
have not seen
Dumb
that.
Money. He is about
No,
the
but he comes off as the smartest guy in the whole film, actually.
Exactly, and I think that, you know, for that part of the city, that would be great. I mean, Citi Field is a fantastic building, but boy, what we're seeing in the stadium business these days, especially down in Atlanta, is not just the stadium, but all the areas around it with its retail and multiple use, and I think that's what he's looking at.
Yeah, I mean, definitely the area immediately next to Citi Field could use some sprucing up.
I'm still stuck on downstate. That feels like a big insult. But let's move on to one of the other big stories today. This was really interesting. SHEIN, I believe that's how you pronounce it.
Shine?
Scarlet and I, well, we think it's SHEIN. We Googled it, etc.
We checked with our experts on our team.
Yeah, the young people on our team, because it feels like another iteration of fast fashion. But in any case, it's said to target up to a $90 billion valuation in a potential U.S. IPO. Again, this is according to people familiar with the matter, but apparently the company has told prospective investors that it's aiming to fetch that valuation about $80 to $90 billion in any listing, though, of course, a lot of this remains uncertain.
Yeah, but you know, they're targeting $80 to $90 billion, but in private trades, SHEIN's valuation has dropped below the $66 billion it got in a funding round back in May. You mentioned fast fashion. I feel like this is the 2023 version of, what is it?
Forever 21.
Forever 21
exactly.
or H&M or something like that. The clothes apparently don't last. You can't wash them.
Yeah,
is what we're
pretty much.
told.
They disintegrate, potentially.
I mean, obviously, I don't have to point out that fast fashion is like bad for the environment and bad for humanity, and basically it's just people being selfish, taking advantage of children in third world countries to do work for them. I mean, that's not the wrong take,
Is that
right?
a more controversial take than peak rates? I don't know.
Exactly. Well, you know, you think we're talking about companies and eye-catching valuations on a day when we work bankruptcy. You know, we're talking about a company that had a, you know, just a
Fun
monster valuation
juxtaposition.
back in the day.
Well done bringing together all the top stories for us, Paul Sweeney.
Thank you.
That does it for now. We're going to be back again in less than an hour, live on television and radio, as well as YouTube at 4 p.m. Join us for our Beyond the Bell coverage when we take you through today's market close. And, of course, a reminder that Bloomberg Business Week is now available on Bloomberg Originals. And of course, we're just getting started here because we've got less than an hour to go before the market close. So we want to bring in Kim Friedricks, Managing Director of Fixed Income at Kayne, Anderson and Rudnick, to talk a little bit more here. And it's good to speak with you, Kim. We were joking around with Paul Sweeney about making this call that we've hit peak rates. Where do you sit on this debate?
I don't think we're actually there right now. We might have hit it when we hit the 5 on the 10-year, but, you know, it's dicey. I think the Fed has made it very clear that they were using the market and the market was doing a good job as we got the 10-year up around 5 doing some of their work for them, lifting rates, lifting mortgage rates, pushing, money more expensive, getting it where it needed to go for the Fed's work to get done. And if we're going to listen to them say, oh, it might be there already, and then drop back 50 basis points, that might be a little bit of an overreaction. So we might have to move up a bit from here.
Yeah, I feel like every day is an overreaction when you get something more than a 10 basis point move in the 10-year. Is there sufficient liquidity in the Treasury market right now? Because when you see 10, 50 basis point moves, is that a result of thin liquidity?
I think that's just an overreaction to every number. I think everyone's looking for that guiding light, that's going to tell them this is the number, this is telling me where we are, where we're headed, and people are reacting, maybe overreacting to everything. There's a lot of covering shorts or putting shorts on. There's a lot of moves going on right now.
Yeah, and Kim, that's something I've been wrestling with. Again, when we see these huge moves, these 10 basis point plus moves in either direction on the 10-year Treasury yield, of course, we're talking about the biggest bond market there is. And is there a fundamental message to be gleaned from those types of moves, or should we be taking this with a grain of salt, saying maybe this is short covering, maybe this is some other technical positioning related factor?
I think if you're just looking for a common sense version of it, I think it just tells you that the market doesn't know which direction we're going next. I mean, is this we're done and things are going to settle down and maybe a 450 on the 10-year or a 440 is the right level? Or are we going to go back up to 5 or through that? And I think there's a lot of uncertainty about that. So every little bit of information means we have to make a big move. So maybe it's not the time to be, putting your toe in unless you feel strongly.
Well, that's also where I wanted to go. Of course, when we talk to people about the long end, it seems like the daredevils are making the case that 5%, maybe that was the ceiling. You think about the risk reward here, and the long end looks really good. Stepping into duration looks really good. Where do you fall on that debate?
I think right now is not the time to be going out to the 20, 30-year area. I think you could see an awful lot of things happen. There's a lot of debt that needs to be issued, and there's a lot of people in the bond market that aren't happy about that. We're not seeing anything, we're not hearing a peep out of Congress that would convince anyone that the level of issuance is going to be able to, slow down. So that's going to cause some problems. I'm not seeing inflation dropping into the low 2s in the next 2 months. So where everyone gets the concept that the Fed's going to be cutting real soon, I'm kind of confused about that.
Yeah.
I could see next summer having conversations, but not now.
Yeah, it's hard to understand how you can go from no longer hiking to let's cut right away, but the market is always looking ahead. You mentioned the Treasury issuance. There was a 3-year auction today, and in terms of what happened, it was awarded at 4.701% compared to 4.702% at the 1 p.m. bidding deadline. What does that tell us about what kind of demand we'll see for the longer end of the yield curve when we get those auctions later this week?
I don't think the short end's necessarily telling us a lot about what the long end's going to do. I think the short end's telling you that people are comfortable with the yields in the short end, that those numbers seem nice, and let's get in there. Let's pick up some yield on the short end and be happy with it. Whether that means that you're happy to put money out to the 20 and 30 is a whole other idea. So we'll have to see. Maybe some people are. I mean, a lot of people have a lot of different views. You can tell that when every dot of news that comes in, we see massive moves in the market. There are people willing to jump on both sides of this teeter-totter we're seeing right now.
All right, Kim. Well, it's going to be very fun to watch. Like Scarlet said, of course, we have 10-year and 30-year bonds being auctioned off later in the week. Kim Friedricks, Managing Director of Fixed Income over at Kayne, Anderson and Rudnick. Thank you for joining us. Now, coming up on the close, we'll get insight on the markets from Jim Reynolds, Loop Capital founder, chair, and CEO.
Plus, we'll speak with Ken Bentsen. He is president and CEO of Sifma. He'll give us his take on financial regulation and why he says the SEC is moving too quickly.
And a conversation coming up with Adrienne Harris. She is New York State Department of Financial Services Superintendent. All that and more coming up. This is The Close on Bloomberg. All right, let's focus on some of the key issues surrounding financial regulation right now, including the potential harm of too much regulation. Romaine Bostick back with us now on Capitol Hill. Romaine, take it away.
Yeah, that's really been all the talk down here in Washington. Right now, the Sifma annual meeting is taking place, the Securities Industry and Financial Association. And we should point out here that there's been a lot of discussion here about how the broker-dealers and the investment banks and all the other institutions that they represent are going to be affected by some of these regulations if they do indeed come to fruition. Pleased to say that Ken Bentsen joining us right now. He's the president and CEO of Sifma. And Ken, a little bit earlier at your annual meeting, we had a chance to hear from Gary Gensler, the chairman of the SEC. And I think the entire world, the entire country right now is sort of waiting to hear the formal rulemaking that he has put out there here. And he kind of gave you a taste of that today. What did you make of some of his comments, particularly when it comes to leverage in the Treasury market?
Well, first of all, thank you for having me, and always great to be with you and at Bloomberg. Well, Chair Gensler's put out a proposal for clearing of cash and repo Treasury, which is already moving in that direction to a large extent. But this would be a mandate for members of the clearinghouse. Our concern is we need to think about how this is going to be done, who's going to pay, incur the cost, because clearing's not free. Making sure that FICC is prepared, the Central Clearinghouse is prepared for this, and that the counterparties are prepared to do it. So it goes back to the point at the lead of we have so many different rules that are coming in. We're moving through the shortened settlement cycle right now. That's a foundational rule. We have to be careful we don't put too much on the system too quickly.
Why do you think, though, that we're seeing so much being put on the system right now? I mean, we've heard from some of the regulators who basically said there has been a dearth, in their words, a dearth of regulation over some of the issues that we've confronted here, and that's why you're seeing so much rulemaking now.
I think it would be hard to say there's been a dearth of regulation over the last decade since the Dodd-Frank Act. There's been a tremendous amount of regulation that's been going on. So, but I think in the Treasury market, obviously there's been concerns among the official sector around resiliency in that market, and there are a lot of reasons for that. Number one is we've seen, the number of primary dealers has been relatively constant, and the balance sheet of the primary dealers has also been constant. At the same time, we've seen an exponential growth in the amount of Treasury debt outstanding. Mm-hmm. So that obviously impacts issues. There are areas where we agree that in terms of certain firms that should be registered as broker-dealers in the Treasury market. Right. But again, we have to be careful how we implement these rules.
But why do you think there has been so much focus on the basis trade? I know there were some disruptions we had early in the pandemic regarding that trade, and it seems to be that's the place that Gary Gensler and some of the other regulators are coming from right now.
I think they're concerned that there may be excess leverage that in a tight period could have knock-on effects in the market. We haven't necessarily seen that, but I think they're worried where the markets get brittle, liquidity gets brittle in the market, that the basis trade could be a component of that. So I think that's what they're looking for.
You mentioned the shortening of settlement. Well, we're now at basically T2. We're trying to get it down to T1. A few years ago, we went from T3. I mean, what's the holdup now that gets us from 2 days to 1?
Well, when we did this back in 2017, we were taking a third out. Now we're talking about taking 50% of the period out, and that gets tighter when you go cross-border. We're going to get it done. We've been working on this since 2020 with our colleagues at the Investment Company Institute and the DTCC. Yeah. But there are a lot of moving parts, and so we put together playbooks. We have 203 days until we get to the date we have to get this done. Right. But there's still a lot of work to be done on it.
Well, and there's a lot of, I guess, lack of overlap, too. I mean, there are some date issues here that I know some of the ETF providers have raised some concerns here that they're going to be subject to T1, yet some of their underlying assets will still be subject to T2, and basically that leaves them holding the bag for 24 hours.
Well, we will have a differential, and cross-border differential, because Europe, UK, the rest of the world except India will still, and Mexico and Canada and the U.S. will still be at T2. We were behind Europe and the UK at T3 before we went to 2, so we've had that differentiation before. We're trying to work through those issues. There's some, there's some that are going to take, are not easy, but I'm confident that we can get it done.
Another big issue for the firms that you represent has been what's been going on with ESG and I guess the freedom, to make a decision about how you want to structure portfolios surrounding some of those issues here. I know Sifma has been part of at least one big lawsuit in the state of Missouri, pushing back there on the Attorney General's restrictions on using ESG policies in investment decisions.
Well, our complaint with the state of Missouri is really not about ESG as much as it is about the state imposing a standard, whether it's ESG or faith-based funds, whatever it may be, that's contrary to federal law. Congress passed something known as the National Securities Market Improvement Act in 1995 that preempts the states, including the state of Missouri, from imposing their own books and records requirement, and that's what the state's rule from the Secretary of State has put into place. So, we appreciate the state, wanting to have their views, but they can't be contrary to federal law. So that's why we brought that suit.
But you've probably seen the trend. It's not just Missouri, it's Texas, it's Florida. A lot of states are moving in this direction. And there is certainly a constitutional issue that I guess the folks behind us will have to sort out at some point, or maybe the folks at the Supreme Court will have to sort out here. But can the firms that you represent, can they operate in an environment where we do have that fragmentation on the state?
No, I mean, that's why Congress, going back really 80 years, 90 years ago, created the national market system we have today. And that's when in 1995 they updated that with NSMIA, the National Securities Market Improvement Act. So we don't have a patchwork, that we do have a federal market system, which is why we have such a strong market system in the U.S., that we don't have 50 different states and the District of Columbia and Puerto Rico and others having their rules. So what our members just want to serve their clients. If their clients want certain products and those are legal, they want to be able to provide those products with them. The client gets to choose what they want. And by the way, under things like Reg BI, fiduciary duty at the federal standard, we have to oblige to what our clients want. So we're not making choices for them. They're telling us what they want.
All right, Ken, great to have you here. Really appreciate you stopping by. Fresh off of his annual meeting over at the Securities Industries and Financial Markets Association, Ken Bentsen there, President and CEO of that organization. Back to you, Scarlet.
All right, Romaine, we'll be checking in with you a little bit later on to discuss the growing federal budget deficit. He'll be speaking with Louise, Sheiner, Senior Fellow for the Hutchins Center at the Brookings Institution. This is The Close on Bloomberg.
All right, just over 30 minutes to go left in this trading day. The S&P 500 sitting on gains still, about 0.4%. But Scarlet, we know it's not about the magnitude. It's about the quantity. This would be the 7th straight day of gains for the big benchmark there. Longest streak in 2 years.
Yeah, continuing last week's monster rally, which of course was predicated on this idea that the Fed might be done with raising rates, but that doesn't necessarily mean any rate cuts are coming anytime soon. We live in strange times when you look at the Treasury yield and it's down 7 basis points, and you're thinking, that's not a big deal.
I know, a real snoozer, but still, you think about maybe not the rate of change. You take a look at the level, and we're below 460. We were above 5%. 2 weeks ago at this point, so it's been a dramatic move lower.
Yeah, dramatic moves daily. And of course, the VIX, not so dramatic. It's below 15 again. How reliable is this gauge for you?
I don't know. I don't know how to read it. It just feels like it's been so disconnected from the intraday volatility that we feel in the equity market, but maybe we're not supposed to follow every single tick like we do. This is The Close on Bloomberg.
All right, right, we're just about 30 minutes away from the close, and Katie, it does look like the S&P 500 clinging on to that 7-day of gains.
Maybe it's going to do it. We're going to count down to every single second, and if you take a look at the sector level right now, it's pretty much an even split. Up at the top, you do have big tech, information technology sector up by 1.3%. Consumer discretionary having a good day as well, up 1.2%. Communication services, etc. Then you go down the list. What's not doing too well, it's real estate, it's materials off by more than 2%. And once again, at the bottom of the pack, it's energy, Scarlet, off by about 2.3% today.
Yeah, energy reflecting the fall in oil prices, whether it's Brent or WTI. Let's take a look at some of the big movers on the day. Datadog is a cloud software company that analysts say is one of the most shorted and oversold names. It had a beat and raise quarter last quarter, and as a result, that triggered a round of short covering, and you can see other similar cloud software companies getting a lift. Snowflake up by more than 10%. Also, you have names like MongoDB surging as well. And of course, Snowflake doesn't report earnings until later this month, and MongoDB reports earnings in early December. Now, meantime, you have Air Products and Chemicals. That is the worst performer in the S&P 500, down by more than 12%. The hydrogen supplier reported a sales miss for last quarter. Analysts do say that overall the numbers don't look terrible, but again, we have this situation where if you miss, investors will punish the stock. In addition, Air Products and Chemicals forecast marks up the cost of its clean energy complex in Louisiana to $7 billion from the previous $4.5 billion. Emerson Electric is runner-up, the second worst performer in the S&P 500, losing more than 7.5%. It did fall as much as 9.4% at one point. Fiscal fourth quarter sales and profit missed analyst estimates as well. Katie?
All right, well, let's go from stock markets back to the world of higher interest rates, because according to a Bloomberg analysis, interest payments on the U.S. government debt climbed past $1 trillion at the end of October. Now, that amount, it's doubled in the past 19 months. And back with us now from Washington is Romaine Bostick.
Yeah, this is really the hot topic down here, Katie. Joining me right now is Louise Sheiner. She's senior fellow for the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institute, and really just one of the foremost experts on fiscal policy, a career at the Fed and at the Treasury, as well as on the tax committee here, right where we're sitting here on Capitol Hill. Let's start off with the federal deficit, because this is that year where I think economic expectations really exceeded everyone's expectations, but so too did the federal deficit. $2 trillion as of the most recent fiscal year. That's double what it was the previous year. Are you pulling your hair out over that?
I'm not pulling my hair out. Well, first of all, let me thank you for having me. I'm not pulling my hair out of that particular number. If you sort of look at the causes of the rise between last year and this year, it is really a lot of special factors. For one, taxes were extremely high last year, much higher than you would have expected before the pandemic, much higher than historical average of share of GDP. So they came down somewhat this year to more normal levels. On top of that, a lot of things were holding back taxes this year that were very much temporary. So for one, there was a delay in tax filing for people from California from really the beginning of January till now, November 16th. That pushes revenues out of the fiscal year, which ends at the end of September 30th, into the fiscal year 2024. That was one factor. Another was that there was this surge of delayed filings on the employee tax retention credit, which was also, now the IRS has stopped them. It's looked fraudulent, but that also was responsible for lower taxes in 2023, and those things are temporary. So really, the lion's share of the increase in the deficit was lower taxes this year, and it's not stuff that makes me think that taxes are going to be lower going forward. In fact, once you do all the adjustments, taxes were quite reasonable this year.
Well, one thing, though, that we are almost certain of is that the costs to borrow, the cost to service debt is going to be higher going forward than what it was over the past 10 or 15 years when we effectively had, 2, 1, and eventually 0% interest rates here. How does that factor in to deficit spending and, more importantly, the outlook for it?
Yeah, so there's two reasons that we think interest costs are going to be more. One, we have much more debt. So we raise our debt to GDP level from 80% to 100% during the pandemic. So that just leaves us with a bigger stock of debt. And number two, interest rates have increased a lot lately. Now, it's really unclear what is behind the increase in interest rates. It's unclear if this is like a new normal or whether or not something's just happening and it's going to come back down. And so I wouldn't say for sure that we know interest rates are going to be higher than they were before the pandemic. The stuff that was keeping them low before might return. But it's very important for the trajectory.
Well, let me ask you this, though, because, I mean, we can quibble over sort of all the reasons as to what's driving this, and we know the folks behind us will quibble to the hilt here. But is there sort of some sort of consensus on how you would reduce the deficit in a responsible way, sans just raising taxes to a gazillion percent?
So I think that people have many, many ideas. CBO puts out a book of options every year. Nothing is easy. You can't reduce the deficit without any pain. It's probably eventually going to require some combination of tax increases and spending cuts. And I think what's really important is that when you make those changes, that you think about what's good for the economy. Don't cut the things that are important for the economy. Don't cut investments in kids. Don't cut investments in climate change. Don't cut investments in infrastructure, because these are things that actually help the future, which is what lowering the debt is all about.
Yeah.
We actually have a game.
Yeah.
If I could talk about a game,
Yeah,
it's called The Fiscal Ship. It's at fiscalship.org. It's a free game. It's been played over 1.5 million times. And the point of the game is you decide what your values are for government. Is it fighting climate change? Is it cutting taxes? Is it making the government smaller? Both sort of bipartisan values. And then you say, how do I keep the debt to GDP from rising while also keeping within my values? And there are over 100 policy options that you can choose from. So there are many ways to do it, and you just have to decide where you're willing to take that compromise.
This gets down to the other issue, though, too. We obviously focus a lot on taxation and on some of the entitlement programs and spending programs as well here. But why do I need to be concerned about 100% debt to GDP rate? If we were another country, I would say, sure, be concerned. But this is still the exorbitant privilege of the U.S. dollar. This is still the world's largest and strongest economy. Why do we need to be that concerned about it?
So we don't really need to be concerned about the level so much as the trajectory that we think is just going to keep rising and keep rising and keep rising, because we might have exorbitant privilege now, but we can't just keep borrowing more and more and more forever. At some point, we're going to lose that. And so it really is about not making things much worse over the future. And again, the debt...
I'm sorry to stop you, but is that in a vacuum of just looking at what the U.S. debt to GDP ratio is doing, or are we looking at relative to other developed nations as well?
Well, so it's looking at relative to our GDP, and I don't think relative to other nations necessarily matters. It matters more when you're thinking, well, what our interest rate is going to be. But the fundamental driving factor behind our increase in the deficit is really affecting all nations, and that's population aging, right? So we have an older society that pushes up spending on Social Security, pushes up spending on Medicare. We're going to have to do something, or we'll just keep borrowing more, and that is something that affects many nations.
All right, Louise, this was a great conversation and great to have you here.
Thank you so much.
Louise Sheiner there. She's Senior Fellow for the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution here in Washington. Back to you in New York, Scarlet.
All right, great conversation. Romaine, of course, will pick it up from here, but we will join you in Washington in just a few. In the meantime, coming up, Rivian is due to report results after the bell. We will break those for you when they come, but we'll give you a preview of what to expect next. This is The Close on Bloomberg.
All right, it's time now for our stock of the hour, and today it's Rivian, out with results after the bell. And for more on what to expect, let's bring in Bloomberg's Detroit bureau chief, David Welch, here in person in New York City. So Rivian, talk to us about what we should be looking at. I see the headline right now is cash burn, but what details will you be paying attention to?
Cash is the big one. They just raised $1.5 billion with a convertible debt offering that kind of surprised investors and wasn't all that popular. Shares are up a little bit today. I think maybe there's some hope that they could be on the path to a better cash situation, but they've burned quite a bit. They have about $4.5 billion left, or $4.8 billion in cash left. Lucid also going to announce later today in a similar position. They're expected to burn close to $1 billion in cash, which is close to half of what they have. So both companies are in a position where they sell expensive vehicles that they can't sell in big numbers yet. They need to do that to get to scale, to lower their costs, and they need to get bigger numbers to get into a better cash position. So another question is, will the EV market, will consumers cooperate with them and buy more of them fast enough?
And you mentioned that they're in similar financial positions, but just anecdotally speaking, I feel like I've seen Rivians on the road. I don't know if I've ever seen a Lucid actually out in the wild.
I've seen them. It's a big, expensive sedan. It's actually kind of got a futuristic look to it. They are pretty cool. Rivian's selling much higher numbers. They've had $1 billion in revenue already. Supposed to sell 52,000 this year. That's pretty good for a company that's starting up like this. But when you look at in the grand scheme of things, you've got to get to hundreds of thousands to start getting economies of scale for something like an EV program, and it's going to be a while selling vehicles that start at $72,000 to get to numbers like that.
You're based in Detroit, David. What do people in Detroit think about Rivian and Lucid? I mean, are they concerned about it at all? Do they see it as a future competitor, if not right now?
They did learn their lesson from sort of hoping Tesla would just go away, which is what was happening for years with the domestic auto companies. But Tesla's still the company to beat. And the way I look at Lucid and Rivian is these are EV startups that have to raise money. They're sort of like the EV operations of Ford, GM, Toyota, without this big internal combustion business that prints money to fund it all. So eventually they're probably going to have to go back to the street to raise more money, because right now they're just a cash-losing business that's trying to grow. Ford and GM have the same issues growing their EV business that Rivian and Lucid do, but again, they've got this big legacy business that is going to be around for at least a decade, probably a couple of decades, that makes a lot of money.
Saudi Arabia's public investment fund owns the majority of Lucid. Is there a sense that they're going to have to come in and support the share price, support the company even further?
They very well could, and I think that does maybe give a bit of a floor to Lucid. Rivian's had Saudi backing as well, and so there's speculation and hope, maybe both, that the Saudis would be in for a dime, in for a dollar on these companies to keep them going to eventually get scale, so that they've got a hand in that technology and in that market.
And just zooming out a little bit, reading some of Bloomberg Intelligence's write-ups of what to expect for Rivian in particular, they mentioned that we could see falling demand for EVs in general that could lead to a scaled-back assembly rate. Talk to us about the demand for EVs, because it feels like, again, this arms race to get your EVs out the door, but is the demand really there?
There is demand, but let's be careful about this. When people talk about falling demand, what we're seeing right now is falling growth rates. So EV sales are still growing. Rivian sales doubled. That's very good. They're still at small numbers. So you are seeing growth in EVs. Tesla's still seeing growth, but Elon Musk said on the last earnings call, he mentioned affordability 5 times. They've got to get prices down of their vehicles and sell cheaper offerings to do it. Tesla is going to be making a $25,000 vehicle. They've been talking about it. GM's looking at a $35,000 vehicle. That's where the market's going, because they've already kind of sold EVs to early adopters and luxury buyers. Now they got to hit the mass market.
All right, David Welch, it's great to see you in person. Of course, that's our Bloomberg Detroit bureau chief. Now, still ahead, counting down to the closing bells, Katrina Dudley coming up next. This is Bloomberg. This is the countdown to the close. I'm Katie Griefeld with Scarlet Fu. And Scarlet, it looks like we're going to do it. A 7th straight day of gains on the S&P 500.
Yeah, but for the first 30 minutes, it was kind of unclear. And there were a lot of twists and turns, and it didn't look like it was actually going to happen. But then stocks found their footing within the first 30, 40 minutes of trade. And since then, it's been no looking back. And a 7th straight day of gains for the S&P 500, longest winning streak in 2 years. And Katie, the narrative is, the Fed might be done with raising rates, the same as last week, which has propelled us on this, just go all in on equities.
Yeah, it feels like very much choose your own adventure when it comes to narrative. So let's try to break it down now with Katrina Dudley. She is Franklin Mutual Series Portfolio Manager and Investment Strategist. And Katrina, what is the narrative right now? Because for months now, it's been higher for longer, doom and gloom. And now here we are with the longest winning streak in 2 years. What gives?
I think you're exactly right. We've just been reading so many negative reports that are coming out of all of these different investment houses. And I think that the snapback that you've seen in the last 7 days is really just kind of less negative. But it's it's just less negative. It's not people adopting a positive narrative. And we think there are a lot of reasons for you to be positive on equity markets. And we think that that's what's going to drive us going into the end of the year.
Well, give us some of those reasons. Is it corporate fundamentals? Is it a more friendly macro environment? What leads you to that positive outlook?
I think there are a few things. First of all, let's take a look and let's just restrict ourselves first to the United States. Earnings surprises are coming in again. They're coming in around 7% on the earnings line, a little better on the sales line. But this is the third consecutive quarter where we've had earnings beats in the US, which means that analyst expectations are lower than they should be. We have that as the first pillar of this. The second thing is on the employment market. We have people in jobs, and we have some of the lowest unemployment numbers that we've seen for a long period of time. And finally, let's just go back to that Fed. The Fed continues to be supportive of equity markets with a narrative that's been very clear. And I think that that's the third pillar that makes us optimistic.
When you talk about earnings, that's a picture for the U.S. How does it look around the world? Because European companies have been reporting earnings as well. And I know Katie and I don't pay as much attention to the ins and outs of those numbers. But what kind of narrative does that tell when it comes to supporting the global growth story?
I think the European earnings haven't been as good as their U.S. counterparts, and you've seen some, earnings disappointments over there. So from that perspective, Europe's not kind of carrying the weight that it needs to in this world market. Japan has been the surprise, and Japan is actually showing earnings beats. And I think the reason that's a surprise is that no one ever expected Japan to do this. And I think this is really the really early innings of the reform measures that we've been talking about. The fact that companies are now focusing on improving their returns, and they're improving their earnings, they're improving their balance sheet, and they're doing a lot of the things that we like to see.
Do you see any of this leading to a pickup in M&A? Because it's been a really slow couple of years, feels like, for any kind of deal making.
We do merger arbitrage as well, so we pay particular attention to what's happening in that market. Have a look at the energy space. We've seen some big deals that have been happening there. And I think that what companies are doing is balancing the DOJ and some of the concerns that they have there about getting deals through with the idea that, you need to get growth and you need to fill in the gaps that you have. And companies that I talk to a lot of industrial companies, are really starting to fire back up that M&A engine. Now, they may not be doing the 60 billion headline deals that we're seeing in the energy space, but they're all really comfortable doing these $500 million to $1 billion deals. They're tuck-in deals, they're easy to execute, and they fill out their portfolio, and they're going to position these companies really well. So I think we're actually seeing a real pickup in M&A, and we're seeing it across the spectrum.
And so I'm looking through your notes, and specifically when it comes to M&A activity, the fact that it's picking up, some say that that's a bull market indicator. You marry that with the fact that we really haven't seen too much in the way of IPOs. Of course, some companies coming out of the pipeline. How do you marry those two together?
I think in the IPO pipeline, I think we just had too many too fast, and we had a number of companies that came out of the box and that they really probably weren't ready yet for prime time. So I think that we're happy with the slowing of the IPO market. You've seen a couple of deals come through. They've been really headline grabbing type names, like things such as, a Birkenstock that's come out. On the M&A front, I think that, we just haven't seen activity for such a long period of time. We were all concerned that higher financing rates would take companies out of the market and out of the deal-making kind of mantra. But I think because we've seen a number of these big deals happen, despite the Fed raising rates, despite interest rates going up, we're just positive that you can make the numbers work even here.
You're definitely more of a glass half full kind of investor right now. So I'm curious whether that extends to small caps. Small caps, of course, extremely sensitive to economic swings, and they've definitely been lagging behind the large caps. I think of yesterday when the S&P 500 did very well and small caps had fallen 1.8%. And today, again, they're trailing the big caps.
Yeah, if you have a look at that dislocation, we look at the small cap profitable part of the index. So they need to be making money in order to be kind of on our screen. And we look at the gap to the S&P, and it's at 20-year highs. So it's the widest it's ever been. So we think there are a lot of opportunities into small caps. You identify one of the fears that people have is that typically small cap names tend to underperform going into a recession. But I think people are forgetting to really look at the data, because because the amount of that underperformance is about 300 basis points. If you look at it on the glass half full, which you're right to say that's one of the things that I always look at, the outperformance is in like the 1,000 basis point type thing. So you get a little bit of underperformance. I think most of that has already happened. And then you set yourself up to be so well positioned. So we're really looking hard for some of these small cap names that will be, good stocks in and of themselves. But also I talked about that $500 to $1 billion range, maybe even getting up to the 2 to 3. Small cap stocks are where you will see the M&A happening. So you get that optionality as well.
All right, Katrina, it's always great to catch up with you. Really appreciate your time today. Our thanks to Katrina Dudley of Franklin Mutual. And a really interesting note to end on there on small caps, that maybe all of this pain, all of this pessimism, if you will, has already been priced in. Then you layer on the M&A component. It's really interesting.
Yeah, absolutely. But I think when it comes to M&A, everyone's very weary given what the DOJ has been focusing on. And although the DOJ has taken a couple of beatings when it comes to some of the rulings.
A couple L's, if you will. Again, that makes merger arb in this environment really interesting. We'll see what happens in that small cap space. But on the day right now, it looks like we're looking at another green day.
Another green day, although we have lost a little bit of momentum here heading into the close. The S&P pairing some of its advance only up by 0.25%.
Well, we are moving closer to that closing bell. Full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
All right, about 2 minutes away from the end of the trading day, Katie Griefeld and Scarlet counting it down to the closing bell. Here to help take us beyond the bell, we have a global simulcast in the hot seat today. It's Matt Miller and Paul Sweeney. We bring together all of our audiences, Bloomberg Television, radio, YouTube, etc. And Paul, it looks like we're going to do it. Or should I toss it to Matt? In any case, 7 straight days.
You can. I'll take it, Katie. Whatever you throw my way. Yeah, 7 straight days of gains. That's the longest streak that we've seen in 2 years. And we're helped by, obviously, falling rates. You have the 10-year trading at 4.57 right now, just about 20 days ago, I'd say we were up, maybe even less. We were up at 5% on the 10-year. You've also got falling oil prices. The Bloomberg Dollar Index has come down. So everything looks good for risk-on moves, and that's why we've seen them for a week and a half.
Yeah, I think what gets my attention here is oil. Off more than 4% here today. WTI crude oil at $77.43. It really gets your attention. And it just kind of seems counterintuitive when we've got 2 hot wars going on over in parts of the world where oil is kind of important.
Yeah, that's a really good point. It feels like oil's been losing momentum ever since the October 7th attack by Hamas on Israel. Like it definitely climbed, and then since then it hasn't really regained its any kind of momentum there. And it's not just oil. We're looking at gold, silver, copper, the entire commodities complex lower as the dollar strengthens.
Yeah, it's been interesting, of course, to watch the commodity space as those geopolitical tensions really arise. But right now, we're about 10 seconds away from the closing bell. As you take a look, the S&P 500 looks like we're going to finish with about 0.3% when it comes to gains on that index. That's good enough. 7 straight days. How many times can we say it? Longest streak in 2 years. The NASDAQ as well, having a better day as big tech really catches a bid up about 0.9%. And of course, the Dow Jones going to finish about 0.2% higher, Scarlet. And again, it's not necessarily about the magnitude on a day like today, but more this long streak that we're looking at.
And it is quite the streak. We're, of course, keeping an eye on the settling number so we can give you just how much the S&P has gained during that period. But let's take a look at the group performances here. For the 24 industry groups in the S&P 500, retail, consumer durable, and apparel, and that's really home builders, and software leading the way, all up by at least 1.25% on the downside. Paul mentioned oil prices coming down, and that is dragging the energy complex lower. That group is off by 2.25%. Materials and real estate investment trusts also losing ground.
I'm looking at some gainers. I'm looking at some gainers here, starting with Uber, $100 billion company, had a second consecutive profit on the bottom line, but its ninth consecutive operating profit, which beat analyst estimates at $1.09 billion. They also had bookings that were better than expected, and although sales fell a little bit short, they said it was a business model change. Investors seem to be happy to give them the benefit of the doubt. Also, Datadog.
That's still a thing.
Had you ever heard of Datadog before? Because I had not, and it's like a $35 billion company. Apparently, they make software for the cloud like everybody else in the entire world. But third quarter results beat, and they boosted their forecast. Bloomberg Intelligence said that supports their view of the long-term demand opportunity for cloud software makers. DR Horton, DHI the ticker, also up after fiscal 2024 guidance signals growth ahead. Obviously, builders have fared well as, existing homeowners have declined to move out, and that means new homes are the only choice. And then Hims. You know Hims?
Is that like Skims? What's Hims?
Hims. I think it's like pills that you take if you need hair.
Yeah.
So can you tell us about that?
So it's the market for me. Hims and Hers, apparently, is what it's called. I think they want to be more politically correct. Those shares absolutely soaring after they came out with earnings also that were much better than analysts had expected, and analysts were very happy about that. Yeah, up 11% there, Hims. To 697.
All right, on the downside here, I mean, there's a couple themes out there. One is that earnings still matter. And boy, if you miss, this market's going to take you out to the woodshed and fast. I go with some industrial companies here. ADP, Air Products and Chemicals, APD is the ticker. Some bad results there. Revenues missed. Costs are higher, margins are down. That stock down more than 12% today. And then another stalwart of the industrial might of the U.S., Emerson Electric. Weaker than expected results. Had some analyst downgrades of the stock, and that stock was down about 7% today. And then the other theme here is just simply energy. With oil pulling back, you got a lot of names on the energy space. Schlumberger, Marathon Oil, Halliburton, Freeport-McMoRan, all down pretty heavy today on the pullback in crude.
All right, let's get to the fun stuff. Let's get to the bond market because it was another interesting day, that rally extending. If you take a look across the curve, of course, you can see there at the front end, muted moves, only down about, 2 basis points, pretty much unchanged when it comes to two-year yields. Then you look out the curve, and that's where it gets exciting. 10-year yields down about 7 basis points, below 460. That bid continuing the longer you go out on duration. And it's going to be interesting to see how the rest of this week goes. Of course, we got a 3-year auction, I believe, today. It was pretty mild, but Scarlet and I were talking about this a little bit earlier. We have 10-year and we have 30-year bonds being auctioned off later in the week. There's still a lot of concern over who is stepping into the long end. Where is that demand coming from? Of course, as Treasury continues to boost its issuance, maybe by not as much as expected, but still, guys, I mean, there are a lot of bonds coming to the market.
Everyone get ready for and make some room in your portfolio. Let's break down some earnings. You have Gilead Sciences, the drug maker, reporting results. Third quarter beating analyst estimates. Adjusted EPS $2.29. Analysts were looking for $1.92. Revenue in the period $7.05 billion. Analysts were looking for $6.8 billion. So clear beat there. And Gilead raises its forecast as well. So the outlook is better than expected. And as a result, you are looking at the stock moving up slightly in after hours trade, 1.7% higher. Gilead also maintaining its quarterly dividend at 75 cents a share.
All right, I'm looking at Rivian here. The company says that it has some, I guess, better news than anticipated. For example, the adjusted loss per share, we were looking for $1.32. They're only going to lose $1.19. They also said that they expect an EBITDA loss for the full year of $4 billion rather than the $4.2 billion that they had previously seen. And they're going to produce more vehicles than they previously expected to, although not by much. They were going to produce 52,000 vehicles a year. Now they say 54,000 vehicles in this year. And that's really the heart of the problem for Rivian, right? You can't get to scale when you're only making 54,000 vehicles a year. It's just tough. And they say they're no longer subject to an Amazon exclusivity deal. I saw my first one of those recently because they make big, electric delivery trucks for Amazon, but also not very many.
So that kind of goes to the EV story in general. Are we at a little bit of a flipping point, Matt, where it's maybe the demand isn't what we initially thought?
I mean, I think Rivian's a great example for that question because we always talk about the fact that early adopters got their EVs already, right? And rich people who want everyone on the block to know they're against climate change too got EVs already as their third car. So that market is saturated. Now you need people who just want to buy cars. And it's unlikely that one of those people is going to also want to shell out like, $95,000 for an 850 horsepower Rivian.
Especially if they don't have a charger in their garage and they have to go look, on the street or in parking lots for that.
Range anxiety is real. But Matt, you know the competitive landscape better than most. You think about some of these EV upstarts. It's not just Tesla that they're going up against. I mean, you have a lot of the traditional automakers coming out with their own EV strategies. Where does that leave a Rivian? Where does that leave a Lucid, for example?
Okay, Lucid like far away, right? Rivian I thought was going to be a real contender because RJ Scaringe took like a decade to set this company up. I thought, all right, he's taking his time, he's being meticulous. But in terms of, the incumbents, Paul and I were talking about this earlier, they're making something different. Tesla and Rivian and Lucid, they're making like luxury products or super lightweight vehicles for very futuristic people. General Motors and Ford, they're just making cars that happen to be powered by electricity, and the consumer doesn't care, especially if you're going to charge $10,000 or $20,000 more, and there's nowhere to charge it. And even if there is, it's going to take you an hour.
That's the part that gets me, right? Filling up a gas tank takes 5 minutes, whereas sitting there in your car, otherwise you're charged if you don't do it. If you leave the car, that's kind of painful in this economy.
Also, I forget to charge my phone all the time. I can't remember. In terms of having to remember to charge my car, I could see it just turning into a disaster. But guys, we got to go. That does it for now for our cross-platform coverage of the market close on Bloomberg Television, Radio, and YouTube. I'm sure you guys will have a great rest of the program. And just a reminder, of course, Bloomberg Business Week now on Bloomberg Originals. We'll be back tomorrow, same time, same place. All right, coming up, a conversation with Adrienne Harris, Superintendent of the New York State Department of Financial Services. This is The Close on Bloomberg. All right, trading is closed on this day, and we're looking at the 7th straight day of gains for the S&P 500. I'm going to keep telling you that stat because it's truly astounding. Longest streak in 2 years. The S&P 500 up by 0.3%. Big tech up even more. The NASDAQ 100 up by about 0.9% today. It helps that you're seeing a rally in the bond market. You take a look at Treasury yields right now, falling 7 basis points on the day. The 10-year yield below 460, on its way to 450. We'll see if we get there. Meanwhile, the VIX absolutely just draining. It's below 15 right now, trading at 14.8. So that's the macro picture. Let's take a look at some of the individual movers today. I picked a bunch of earnings stories, and apparently they're all good. You take a look at Datadog, absolutely flying today, finishing higher by 28.5%. This is a cloud software company. It was a beat and raise quarter. That's also lifting the likes of Snowflake as well, of course, one of its peers. That's good for an 11% rally. I also want to talk about Uber as well. It was a mixed result. There was something for everyone in it, but it seems like the bulls won out when it comes to the end of today, finishing higher by about 3.7%. And Olaplex as well. This is a beauty company. They make hair oil, etc. They also had a pretty good quarter. Of course, sales coming in heavier than expected, finishing up about 25.4% when it comes to the share action. So that's the micro. Let's take a look at the overall positioning when it comes to the big benchmark, the S&P 500. You take a look at the CFTC positioning, and we had this big net short earlier in the year. You can see really the depths of it the most in almost a decade or longer. We are back to just about neutral. There is a very positive net long when it comes to the S&P 500. But Scarlet, you take a look at that. A lot of shorts have been flushed out, positioning getting back to neutral. Going to be fascinating to see where we go from here.
Absolutely, and that might explain some of the large moves that we've seen of late. In the meantime, let's go back to Washington because regulation on how to tackle cyber threats were big topics of conversation at DC FinTech Week. Let's head back to Washington where Romaine Bostick has a special guest. Romaine?
Yeah, thanks, Scarlet. I'm here with Adrienne Harris. She is the superintendent for the New York State Department of Financial Services. And of course, we're not in New York State. We're in Washington, D.C. And a big part of the reason is for FinTech Week, and where you were on a panel that had the very lofty ambitions of discussing how to regulate AI. And I am curious as to what role the State Department would have in doing that.
Yeah, absolutely. Well, first, thanks for having me. We play a central role. As you know, at DFS, we regulate banks, insurance companies, crypto, you name it, it really does fall under our purview. And so therefore, AI and the technological innovation that comes as part of financial services is also part of our purview. So we look at both how our regulated entities are using AI, and we in fact have some insurance guidance soon to come out about AI and underwriting. But we also think about how we ourselves as supervisors should be using AI.
Well, let's talk about some of the companies that I guess are under your purview. I mean, you oversee something like 3,000 companies, like $9 trillion in assets, and a lot of those are insurers.
Yes.
And when we talk about AI, even generative AI, some of those insurers will say they've been using some sort of form of machine learning or AI for years now. What's different now in the way that they're using it versus, say, I don't know, 10 years ago?
Yeah, I think now they're using it in a broader array of activities. So historically and over the last several years, certainly in customer service, say, or the chat bot on the website, we've seen them use AI and machine learning. Now what we see is more in claims, in underwriting, in pricing. And so while DFS has had guidance in the past, like with many technological innovations, now it's time for an update so we can make sure the guardrails are clear.
I don't think anyone doubts the importance of your agency, given that it oversees what is effectively our financial capital here in New York. But there's been a lot of discussion about whether these rules should be coordinated at the federal level rather than allowing states to do this one by one.
Yeah, absolutely. And we coordinate with the federal regulators all the time. As you know, I spend time here in Washington at Treasury and at the NEC. And because it is the financial capital, we're coordinated with federal regulators and with international regulators because we regulate so many international institutions. So it really is that balance between harmonization, but leading the way and leveraging the nimbleness of a state agency to stay abreast of developments in technology.
I was speaking a little bit earlier with the acting comptroller, Michael Sue, and I asked him about some of the lags in regulation versus the way the industry has sort of run forward with this here. And he admitted that they're behind. I guess my question is, how does the government catch up? Because the government has never really been known for speed when it comes to regulation.
Well, I think it's an important question. You don't want to front run innovation, but you want to be close in time to make sure those guardrails are there to protect consumers and markets. It really is one of the virtues of being a state regulator, especially in the financial capital, where we've got tech, we've got the financial services industry, so that feedback loop is tighter and faster.
I want to ask you about what's going on in the regional banking sector. Obviously, the SVB fallout in California earlier this year, of course, dovetailed with Signature Bank in New York, which was under your purview. There's a lot of discussions right now about why regulators either didn't know what was happening, or if they did know, why it took them so long to make some sort of preventative measures.
Yeah, well, first, the banking system is stable and sound. I think all the regulators, from state to federal regulators, took swift action to make sure that was the case. So
we don't need to worry about another signature. We don't need to worry about another SVB.
The banking system is very sound. The core of it is very solid. I think there are lots of things to learn from this, whether it's about needing updated regulations that are fit for a 21st century. We know the role that social media played in those runs earlier this year. But it's also about how you operationalize regulation. So we're doing a lot of work just internally on how things get escalated within the department, how we tighten that feedback loop between the examination and giving feedback to the bank and making sure they're remediating in a timely manner.
Well, when we talk about some of the new technologies, so whether it's AI, the role of fintechs and non-bank financial companies in the system here, do you worry at all that some of the issues that sort of exacerbated the regional banking crisis, meaning the flow of deposits and the ability to transfer those deposits easily, that will get worse? I mean, we're talking about reducing settlement times. We're talking about potential open banking rules and laws that would effectively allow the free flow of money. That's good for consumers. But if we get another bank run, I would think that could have potentially devastating consequences.
Well, that's the importance of having regulators that are nimble, that can respond and anticipate risks like that. So as liquidity is changing, as technology is changing, We have to be able to write rules and change our operations in a way that's keeping pace with the innovation in the industry.
And you have the support from the governor, you have the support from other folks to do that?
Yes, absolutely. Governor Hochul has been nothing but supportive. In fact, in my 2 years and change in the agency, we've hired or promoted almost 600 people. We're doing a large technology transformation now. So again, it's about the rules. Those are, of course, important, and we want to keep those up to date. But it's also about how you operationalize them and how you professionalize the operation.
All right, Adrienne, going to have to leave it there. I'm really glad to catch up with you here in D.C. That's Adrienne Harris. Of course, she is the superintendent of the New York State Department of Financial Services. Back to you in New York, Katie.
All right, well, let's get to some breaking news on Rivian. Of course, coming out with its earnings report, looks like it sees its full year production forecast up slightly. It also met its estimates overall. And here's some interesting news as well. Rivian vans no longer subject to an Amazon exclusivity deal. Let's get some details now with Ed Ludlow. He, of course, is the co-anchor of Bloomberg Tech, joining us in New York this week. And Ed, we can get to the numbers, but let's talk about what's going on with that Amazon agreement.
Yeah.
What does this mean for Rivian?
Yeah, it's big for the company. Inside, a lot of staff have been super frustrated because they want to sell their battery electric delivery van to so many more. So what it means in the first instance is they can do just that. They're free to talk to third parties. Actually, I know from sources that they probably have been speaking to third parties outside of Amazon. You're talking about fleet operators, right? People that operate all kinds of last mile delivery services. When the deal was signed in 2019, it basically gave Amazon 2 years of genuine exclusivity from the time the first van was delivered, and then 2 rights of first refusal on everything that Rivian builds. And the van's about 25% of total production. So this frees them up, and it's what investors wanted to see too.
Okay, here's my question, though.
Sure.
Like, under the original deal, and Rivian says it still plans to honor its deal to deliver 100,000 vans to Amazon by 2030, but they're not making a whole lot of these vehicles either, right? They're only making 54,000.
So it's why it's important to pass the numbers. They have updated guidance. So this year they'll build 54,000 EVs across their 2 consumer products and the Amazon van. But to all intents and purposes, they are supply constrained. They can not meet the demand that's out there. But on paper, that facility in Normal, Illinois is capable of building much more than they're currently doing. And, I think the fact that they raised guidance isn't a surprise to anyone, really. The after hours move in this stock more likely to do with that they can now go out and plan to sell this product to others. Remember, the second part of that exclusivity, first dibs on everything that's built, that's no longer there. So as long as they meet the 100,000 by 2030, they can sell vans to others, and they can manage that process. And again, vans is 25% roughly of everything they build.
They have to scale really quickly then.
Yeah, exactly. And I mean, you talk about scaling, and you think about, let's talk about the forecast a little bit. I mean, 54,000 vans, it's not very much.
Yeah, so I reported earlier this year, citing sources who were in a meeting with the leadership team, that they told staff on paper this year they could probably do 62,000.
Oh.
And the market's always kind of questioned how conservative this guide is. The facility in Normal, Illinois, based on the machinery that's there, can probably build 150,000 units a year. So you can see the path forward. One thing I always forget to mention, Amazon owns almost 17% of Rivian still. And they still have the deal for 100,000 units. But, I love covering this company because there's still intense Bloomberg Terminal readership interest around the world. People follow it really closely because it's kind of like actually managed to do it, whereas so many other EV upstarts have struggled.
Yeah, I guess the big question is how quickly they can actually execute on these grand plans.
Right.
Ed, really appreciate your joining us. Ed Ludlow is, of course, co-anchor of Bloomberg Tech, giving us the instant analysis on the Rivian news. Let's, for a moment, focus on personal finance and retirement. We're going to head back to Capitol Hill and Romaine Bostick, who has another guest with him. Romaine?
Yeah, no better person to talk about that than Ken Cella, joining us right now. He's a principal for branch development over at Edward Jones in St. Louis. And just today, starting his new role as the chair of Sifma, of course, the Securities Industry and Financial Management Association. Congratulations on your new appointment.
Romaine, thank you. It's an honor to serve in that role. Our industry has such a tremendous impact on hardworking Americans through the policies that are brought forward, through the work that we do collectively as a financial services industry to then bring together the products and services to create experiences for our clients.
Well, as you know, of course, this is an industry that has changed a lot over the last couple of decades, but really over the last few years. Your primary role over at Edward Jones, you're overseeing thousands and thousands of advisors and their firms and the way that they operate here. What do you tell them in an environment like this where there seems to be so much uncertainty, whether it's because of economic conditions or interest rates, or really just the idea here that I guess that business cycle and that financial cycle that we were so used to is clearly over.
Well, I tell you what, the main thing for a financial advisor today is to really become a student, not only a student of the industry, to study what's going on geopolitically, what's happening in our country. I mean, there are wars going on, Romaine, you know that. And so when an advisor is working with a client, they have got to be able to take into consideration everything that's going through a client's mind. A lot of our clients are nervous. They're on edge. They want to know what's going on and how that might impact their portfolio. So becoming a student and really learning is key. The next thing they really have to be able to do for a client is then make sense of it for them, to really put it in terms they understand, to leverage the opportunity to customize a plan that meets the risk tolerance of their client.
I'm curious about the cost structure right now of just wealth management and financial advisory in general. For consumers, that cost has come down. That's a good thing. Has the quality, though, either maintained itself or gone up?
Yeah, Romaine, the cost structure of the financial services industry has been going down for decades, and that's a good thing. I mean, for consumers, a high quality product for a reasonable cost is really what we're all after. And so some of that cost is self-imposed. Organizations look at their value proposition and they're making sure that they're tailoring what they're doing and charging a reasonable fee for the value that's being delivered to their end client. And so your question is about quality. I would say that without a doubt, as I look across the peers in our industry, there's a consistent movement to raise the bar and the quality that we're providing to our clients to make sure we're putting their interests first and really tailoring the products and services to meet their needs.
How does technology and automation play into that here? I mean, we know that there are generational differences, at least if you believe what's out there, the idea that younger generations, they want maybe a little bit more of that technological automation, while the older generations want a little bit more of that high touch, personal touch.
Yeah, we're all impacted so much by technology every day. Not just our personal devices, but also in this day and age, all the information that's pushed to us and tailored to us based on algorithms that are behind the scenes. So an advisor today needs to embrace that technology because our clients want to have a relationship that's both digital and personal. Both of those aspects have to come to life. So organizations in our industry today are really focused on building technology as a backbone, but not to replace that face-to-face relationship. Now look, if a client wants to go all in on just financial digital advice, they can do that. But even the next generation is saying when it comes to their life savings, they want a financial advisor on the other side of the table.
We are on the precipice of what most people think is going to be one of the greatest wealth transfers that we've seen in this country, at least in modern history, with the baby boomers eventually aging out and the wealth that they've amassed being passed down to the next generation. What is the management approach to that from an advisory perspective? What is the management approach to dealing with that shift in wealth?
Well, I think for most financial advisors, what they're hard at work doing is understanding how they build relationships with that next generation. So often that's a natural part of the process of serving their clients, because when it comes to clients and what they really go to advisor for, most of the time what they're concerned about is their health. They want to make sure that their money can help them live a healthy lifestyle. They're interested in their family and passing on the wealth to the next generation, and then having a life of purpose that they can live, you know, a life of meaning and dignity through that purpose. And so it's one of the primary tenets, and a good advisor really develops that relationship and then understands what the needs are of the next generation.
You're embarking now, of course, as the chair of Sifma. What's going to be your primary priority?
Yeah, my primary priority with Sifma this year is to bring the collective benefit of all of our industry companies together to really think through all what I'll say is a unprecedented amount of proposed rulemaking that would stand to change the entire industry's landscape. As we work through that, our singular focus is to put our clients' best interest first. I'll also be focused on continuing to make sure that the value of financial advice is compelling for clients and that financial advisors are playing a key role in that process.
Ken, really appreciate you stopping by.
Romaine, thanks for having me.
Ken Cella there, he's the new chair of Sifma, and he is principal for branch development over at Edward Jones. Katie.
All right, Romaine, thank you for that conversation. And coming up on The Close, we have a conversation with Jim Reynolds. He is the founder, chairman, and chief executive officer of Loop Capital. Don't go anywhere. This is The Close on Bloomberg.
I'm Scarlet Fu. Let's take a look at how markets performed on the day. A lot of green here. You had stocks rising, bonds rising, the dollar rising as well. For the S&P 500, rounding off its 7th straight day of gains. That marks the longest winning streak in 2 years' time. And with the rally in bonds, you have the 10-year yield coming down 7 basis points to 4.56%. Of course, some big moves in the Treasury space over the last 2 weeks after the 10-year hit 5% about a week and a half, 2 weeks ago. And of course, the Bloomberg dollar index moving higher. That is putting pressure on dollar-denominated commodities, including crude oil, lower by 4% at $77 a barrel. You have the VIX coming in as well, below 15 at the moment. The feeling right now among investors is that the Federal Reserve may very well be done with interest rate increases. That's not to say any rate cuts are coming anytime soon, but investors are always looking ahead and hopefully pricing in some of those rate cuts, or at least easing of monetary policy. We'll see how long that lasts for. Katie?
All right, well, let's head from the markets back down to D.C., where our own Romaine Bostick standing by for a conversation with Jim Reynolds, the founder, chairman, and CEO of Loop Capital.
Yeah, absolutely. Here, I mean, one of the big themes, guys, that we've talked about over the last decade is just how much sort of borrowing now is being done in the private markets. That has been the trend in corporate America, and of course, it's been the trend now, believe it or not, in the municipal market. And Jim Reynolds knows more about that market than anyone, trading out of those blue books back in the 80s, and of course, starting his own firm in the 90s, Loop Capital, and growing that from a small muni shop into one of the biggest privately held investment banks in the country. Jim, great to have you here on the program.
Man, good to be here. It's been a while since I've been on Bloomberg, so it's good to be back.
Well, it's been way too long, and of course, you've seen just how much the markets have sort of evolved, if you will, over the years here. Has it evolved in a healthy way?
It has. You know, I think when we look at what happened in 2019, 2020, you know, I never felt very comfortable that we were healthy. When you're in a frothy market like this, you sort of recognize when things just aren't going correctly, when the markets are a little out of whack, when you can't value things, when there's no intrinsic value to what you do. I was speaking today. I started trading bonds in 1981. Interest rates, the prime rate was 20.5%. And the market, the bonds moved in points, not basis points. But you really had a sense of where things were and where value was. When we got into 2020, 2019, and we saw so many unicorns, so many startups, so much going on with the crypto markets, NFTs, just name it, you really begin to lose where the intrinsic value of an asset was or what it was. You come into 2022 and 2023, it was painful, but Romaine, we've washed through all of that. Now we're sort of back to where we were when we look at assets, when we look at companies, when we look at fixed income, and you start to ascribe value to things that are valuable, companies that have earnings, you know, companies that have a solid business, where it's not just a thought or a dream or a concept. And you're back into bonds again. And as you remember, in 2019, 20, 21, we had a lot of clients just moving everything out of fixed income and into private equity and venture and all this. So this is a much healthier market right now.
And it sounds like that's kind of ends up being a bit of a net positive, particularly for a company like yours that has really expanded into doing more deal making, obviously doing some broker-dealer businesses as well. I am curious about the future of Loop Capital. There was a proposal out there, I believe back in 2021, to go public. Do you still have any ambitions to take Loop Capital public?
Oh, 100%. But it's very different than it was then. When we came into 2021, equity capital markets was the dominant part of our business, just like it was with all the other investment banks. I mean, when you saw the revenue, the wealth generated from the IPO markets, there were 7 or 8 IPOs a day and a night. And the outperformance of that asset class to everything else, and M&A was active, was dramatic. You come into 2022, 2023, and Romaine, you see the equity capital markets have all but disappeared in the IPO space, and M&A is also very, very, very challenged. And so
Well,
what we did, though, which I planned to do, and I didn't have a crystal ball, but the plan worked well, was the revenue that we made, like many other firms should have done, we actually invested in assets that weren't correlated to the equity markets. We bought 2 fixed income managers, about $10 billion in assets. We expanded our repo business. We moved into futures. We expanded our infrastructure business, but we did not double down on the equity capital markets. So I expect we'll probably see that again. As you know, there are no the IPO market doesn't exist now. We're
that's
hopeful.
what I'm curious about. Well, I'm curious about what you think about some of the IPOs that we have had, which haven't performed very well, at least in the secondary market. And earlier today, of course, there was a lot of talk about the WeWork bankruptcy and kind of another SPAC deal biting the dust.
Well, SPACs, I think the average SPAC, I would probably say, is down 80% to 100% that came in those frothy times. It's just not, the concept of SPACs is something, we've seen it before. We probably won't see it again in a long time. WeWork was a failed IPO. We were a part of it when it tried to come as a standalone IPO. And then when it had to revert to a SPAC structure to hit the markets, it did not look well, did not do well. It didn't perform at any point up to this. When you look at the IPOs that have come up to now, the ARMS, Cavallo, Instacart, they were set up for success. One, they had very small floats. They sold very small percentage of the companies. Two, they sold to strategics in advance of a public offering to the public. Three, there were really strong incentives not to sell.
Yeah.
And so when you look at these firms that were set up for success, and by the way, they didn't succeed. This week they started bouncing back, but virtually all of them were down 20% to 30%. I haven't seen Birkenstock yet today. It may have bounced back, but Cavallo, Instacart, ARM, I saw ARM is up a little bit, but I would not call those indicative of a healthy IPO market.
Give us a sense here. We only have about a minute left here, Jim, but give us a sense here about the regulatory environment and whether that gets in the way at all of a resurgence in M&A, IPO activity, and really just the healthy functioning and liquidity of the markets.
I don't think so, Romaine. You got my successor coming on now, so I'm just today is my last day as chairman of the board of Sifma. And we had Jerry Gensler speak to us today, and I had a chance to chat with him. He has imposed probably the most aggressive tsunami of regulations that we've seen in modern times. There's no doubt about that. But that doesn't mean that the regulations are bad. What we've done at Sifma, and we had a chance to speak with FINRA yesterday, is really talk to the SEC and work closely with the SEC about the fact that when you have this many regulatory changes in the marketplace, what can be some of the unintended consequences of such an aggressive regulatory regime, and how can you actually accomplish some of these things? Like, we're working on one-day settlement from two-day settlement. Okay, what does that mean to the back offices of the firms that actually have to do it, to the buy-side firms? We're working on one-minute trade reporting. Which is like, okay, why is 1 minute better than 5? Like, what do you get in 1 minute that you can't get in 3? And so we're doing those things. So a good, healthy regulatory market is good.
Right.
Sifma really earned its medal today, this year, because it really worked with the SEC to help actually execute and make some of these rules and regs better.
All right, Jim, we're going to have to leave it there. I really appreciate you taking time for us. I didn't even get to ask you about the Chicago connection, which is like half the reason I brought you on here. But anyway, we'll get to that some other time. We'll do it next time
when I'm in New York, Romaine. I promise we'll come by and we'll do it longer and have a good chat.
All right, anytime. That's the outgoing chairman of Sifma, Jim Reynolds, and the co-founder of Loop Capital. Back to you, Scarlet.
All right, great conversation, Romaine, and it's great seeing Jim Reynolds of Loop Capital back on Bloomberg. Coming up, we're going to give you a preview into Disney because they report fourth quarter results tomorrow. What is expected for the Mouse House? This is The Close on Bloomberg. releasing fourth quarter results tomorrow after the bell. Geetha Ranganathan, Bloomberg Intelligence media reporter, and analyst, I should say, joins us now to give us a sense of what we can expect. And Geetha, there's a lot of different things that Bob Iger has to tackle here. And he's known for being able to manage the investment community very carefully. Good news, a little bit of disappointing news, and then ending with good news. What is his number one talking point, and what is the investor's number one question for him?
Yeah, you're absolutely right, Scarlet. Lots of different moving parts here for Disney. But I think the number one issue right now for them is really progress on the streaming profitability front. So we know that Disney is probably going to lose subscribers. I mean, they've already lost subscribers the past 3 quarters. They probably will have a little bit of reversal in terms of streaming subscribers for, the fiscal fourth quarter, which is what they report tomorrow. But nobody really cares anymore about subscriber growth. It is really all about streaming profitability. And remember, this business lost about $4 billion last year. We're looking to see if they can pair that pretty dramatically. So consensus right now is for about $2.6 billion in losses. If they can come in any better than that, and if Bob Iger can articulate, kind of a timeline for them getting to quicker break even or even streaming profitability, I mean, that would be something that I think investors would really cheer.
Well, Geetha, to that point, I mean, $2.6 billion, that's a lot less than $4 billion, but it's a long way away from a break-even point. Where are we, though, on that path to actual profitability, and what needs to happen?
So they have a lot of the different levers in place, Katie. I mean, they have implemented some price increases on their Disney Plus product, almost a 25% price increase. They are going to follow in Netflix's footsteps and kind of do that password sharing crackdown as well. So expect, again, some more increase in ARPU from that. And then they're cutting content costs as well, which I think is really important. And then I think what we're really going to look on the call is to see if they can offer anything from, the whole Hulu sale process, right? So we know that the wheels are in motion there. Once they kind of bring Hulu on board, I think the big question is, can Hulu actually accelerate their streaming profitability? Because there's obviously a lot of, non-programming cost synergies that could potentially be achieved, when they combine all of their streaming operations. So there are definitely a few catalysts that could come into action.
And talk to us a little bit about ESPN and, of course, the ambitions to transition that into an online product. What are you expecting? What are you hoping to hear on that time frame?
Yeah, so ESPN is obviously very, very essential to Disney's business. We know that because they actually just released standalone financials for the ESPN segment for the very first time in their history. And what we got to see from, those financials, a little peek under the hood, was that revenue is actually holding up really well. It's about $16 billion. Yes, EBITDA is under pressure. They have about $3 billion that they generate, and it's under pressure because of rising sports rights. And they are looking for this partnership, and we still don't know who exactly it's going to be, but they're definitely looking for, I think, a minority partnership from one of the leagues, kind of have that involved, one of those parties involved as they look to transition ESPN into a direct-to-consumer product. That probably happens sometime in 2025. But I think generally there's a lot of optimism that once it does go direct to consumer, like a full-blown direct to consumer product, it can actually pretty much offset the losses on the linear TV side. So I think there is definitely a lot of optimism. Again, we're going to have to wait and watch how kind of this whole minority investment plays out.
And of course, Geetha, we got news this week that Disney poached the CFO of PepsiCo, Hugh Johnston, to join Disney as the CFO there. So that raises all kinds of questions about whether he may be considered a successor to Bob Iger. Is the succession question going to come up in the earnings call?
I think it definitely will. And I think, Scarlet, that's a really interesting point because, Disney has always kind of looked internally. They haven't really gone very much externally for, their C-suite hires. So this kind of obviously raises the question about whether he's the ultimate successor or whether they're still kind of going to look externally to kind of fill Bob Iger's shoes. Obviously, we still have a little bit of time there, another 2 years on Iger's contract. But yeah, I definitely think that is a burning question on everybody's mind.
Yeah, it's been a burning question for years. Geetha, thank you so much. Geetha Ranganathan of Bloomberg Intelligence, and she will join us tomorrow when the Disney earnings cross. Now, We talked about Bob Iger. He is actually what's known as a boomerang CEO. Basically, when companies bring back former chief executives in the hope of fixing some problems. Starbucks, Dollar General, and DuPont have all done the same in the last 3 years. But is this a winning strategy? Helping us now to answer that question is Davia Temin. She is president and CEO of Temin and Company. Davia, always great to see you, and thank you for coming in today. How do you determine whether boomerang CEOs actually work? Bloomberg crunched the numbers and found that these reappointments tend to steady or even give slumping stocks a boost in the short term, but they don't really claw back these lost gains over the long term.
So I think it depends upon what you're looking for. If you're looking to stabilize a situation that's going downhill rapidly or that is a little bit out of control, a little bit chaotic, then what you want to do, then a win is to get somebody who will stabilize it, who's a known quantity, who people have some trust in, and they know the organization. Maybe not in its newest form, but they know it in some way. And so they walk in there with some trust and power. I don't think that you necessarily are looking for share price getting higher and higher than it was before from that boomerang CEO. You're looking for stability and maybe getting it ready to then go to the next CEO with a quantum leap.
So that's interesting because I think about in the Bob Iger case, different skills are required for different stages of each company, right? Iger was this visionary who built up Disney into something much larger than when he started. But is he a cost-cutting CEO? Because that's what's required right now.
We'll see. I mean, we will see. And the question is, how agile are the boomerang CEOs? I mean, are they willing to bend with the reality of the day,
or dismantle
do they
what
just
they
go
built
back?
up?
That's or dismantle. But you know, CEOs have to do that because the world changes, business changes, and this whole idea of grit and adaptability and flexibility, et cetera, it's not just for the populace at large. That's what leaders have to do.
And can you talk us through a little bit of the logic, the psychology beyond bringing back a boomerang CEO, to your point, to stabilize things versus the idea of let's bring in someone new. Let's bring in a fresh slate and really turn things around here. It feels like, you know, trying to fix the same problem, but coming at it from different ends of the spectrum.
Well, you know, let's just bring in somebody new can be naive if the fit isn't fantastic. And succession is hard. It is human. It's not generative AI. There's no algorithm. And people get in and they surprise you because people do surprise you. So when you have somebody who's been successful in the role, you know they have that capability and they have an aura about them. They have their reputation, which is good to rebuild. I don't think that they necessarily stay on there forever. I don't think they necessarily do want to stay on forever. But if it's their baby, I mean, look at Howard Schultz. If it's their baby, if they built it and nurtured it, you know, maybe they want to take it into adolescence. And an adolescent isn't an infant. You don't treat an adolescent in the same way. You treat it very differently.
Absolutely. And I want to talk a little bit about the environment that we're in right now, because as Scarlet read through, I mean, you think about the last 3 years, it feels like we've seen a lot of boomerang CEOs come back, really try to help their companies through the teenage years. What do you think that's about? Is there any one specific line we can draw between those companies or this actual backdrop that we're in?
I'm not sure that there's a line that you can draw. I think it has more to do with, you know, corporate cultures are complex. And if you try to simplify them, you make a mistake. So for a new CEO to be able to grok the new corporate culture, that's a step. And some people are able to do it. And maybe for some, they realize that it's just a misconnect. And then they want to fix it. So there are many ways. Now, there's also CEO hubris. I used to work for GE, and you know, Jack Welch really didn't want to give up those reins because why would you? He loved it. But so there are all kinds of human foibles and human urges that go into this. But for the good of the organization, for the good of the share price, you have to be able to make bold moves. And sometimes a boomerang CEO is a bold move.
Okay, that's an interesting take on it. Can you talk a little bit about the difficulty of finding a successor to founder CEOs? You know, finding the Steve Ballmer to succeed a Bill Gates or whoever ends up taking over from Mark Zuckerberg over at Meta.
That's right. Well, that's the difference, isn't it, between getting somebody who's on the inside, who actually knows how things really work versus the rep that they have out in the outside world, versus bringing somebody in from the outside. So somebody from the outside can come in with all kinds of ideas, but if they don't really mesh with a culture culture of the organization that the CEO, the leaving CEO, has built, you're in trouble, right? So I think it depends upon the succession process. It depends not whether it failed or succeeded, but how nuanced it was and how well that new CEO was able to deal with the nuance and all the surprises that come along with it.
Yeah, I mean, a lot of it depends on the board, because if you have a founder CEO, they tend to control the board, and the board is going to end up doing what the founder CEO wants.
Well, yes, but then if the founder or CEO is leaving for whatever sets of reasons, or is asked to leave or chooses to leave, then the board has to get newfound oomph. Shall we say, and power.
Yeah.
And that's hard, but it's, you know, it's not probably as hard as you think, because a lot of people who've on those boards, they've sat there thinking about what they would do if they were totally in control for a long time, most likely.
Okay. Davia, really appreciate your joining us today. Davia Temin is president and CEO of Temin and Company as we talk about these Boomerang CEOs. Still ahead, what investors need to watch for tomorrow. This is The Close on Bloomberg.